morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. Oh, look at that. It's Brian Sazzi. You'll see Brad Smith this afternoon. Here are three things you need to know this morning. General Motors raising its guidance for the second time this year. Adjusted earnings expectations, EBITDA, rising to a range of $12 billion to $14 billion. So that number is contingent on new labor agreements and no strikes. Revenue last quarter rose to $44.75 billion. That's up 25% and comfortably ahead of Wall Street estimates. The Detroit automaker also ramping up its cost-cutting measures with plans to trim $3 billion in expenses. Earlier this year, it said EV output will accelerate in the second half. It's aiming to produce 100,000 EVs in North America this year. It reached around 50,000 in the first half. Spotify shares are taking a tumble for the second day as the subscriber surge is offset by deteriorating gross margins. Revenue rising by 11%, but that also missed the mark at 3.18 billion euros versus 3.21 billion expected. The report comes after the Stockholm-based music streamer confirmed its long-awaited price hikes, sending the stock to close at its lowest level since mid-December. Spotify tried to allay investor fears over the move, saying it will have a minimal impact on total revenue in the third quarter. And, deep breath. That's just the tip of the iceberg. We're across the industrial space with GE and 3M both lifting guidance on strong numbers. Plus, it's the turn of big tech next with Microsoft, Alphabet, and Snap on the docket later today. The majority of companies out with results are beating the street. They always do, but they aren't being rewarded with a bump in their share prices. We'll get the take of JP Morgan Asset Management in just a bit on why the bar is so much higher this time out.
All right, shares of General Motors are in focus after the automaker reported strong revenue and profit beats today and upped its full-year profit forecast for the second time this year. But investors really had their eyes peeled on GM's electric vehicle outlook. The company reaffirming its plans to produce 400,000 EVs through the first half of 2024 and 1 million by the end of 2025. Julie, I get the EV story. I know why everybody's excited about it. They all want to make comparisons to what Tesla's doing, what Ford is doing, but the story for this quarter for General Motors is they sold a lot more trucks at higher prices, a lot more SUVs at higher prices, and people didn't care about those higher prices, those higher price trim levels. They went out and bought this stuff, and here's another company trading at a discount to the broader stock market, putting up another good quarter, and probably still not getting the love that it deserves.
Yeah, I mean, so the bottom line is demand. People wanted more trucks. So what then do we make of this continued emphasis on electric vehicles at the same time that they're still selling all these trucks?
Well, if you're still selling gas guzzlers and making a lot of money off it, you can invest in EVs. But just going on to demand, I talked to General Motors CFO Paul Jacobson earlier this morning on the demand in the second quarter they saw, which he says was very strong, and the outlook for the back half of the year.
Our biggest challenge right now is we can't get the vehicles to customers fast enough, and we're working on scaling that pretty quickly. But we've been very consistent about pricing to where our demand is. I think when you change pricing that dramatically, that fast, you create confusion in the customers' minds. And I don't want to be the person who bought an EV the day before you lowered the price by $10,000. That's not a great way to manage customer expectations. And that's why we've been consistent. We've seen this happening for probably pretty close to a year around EVs. And while we're ramping up production and fulfilling orders, our customers have told us that we believe these vehicles are fairly priced.
Maybe a little shot of Tesla?
A little shade.
A little spicy?
Shade there.
Spicy. I like the shade, but I like Paul Jacobson. I like that comment right there, but I also like the fact he has been now the CFO for several quarters, and he's come out here and delivered every single quarter. He has set expectations. He's not only delivered on them, in most cases, he has delivered above those results. Those are all the things you want to see, like you wrote in your earnings in the morning brief this morning. That is everything you want to see from a CFO of a very big company like GM.
And again, to come back to what they're spending money on, because that's what you want to know as well. So they're still going to be investing, even as they cut costs elsewhere, they're still going to be investing in electric vehicles and are investing in autonomous driving in their Cruise unit, right, which lost $611 million in the quarter. So that's something to keep an eye on, of course, how much that continues to take away from the company. And then lastly, something else I have my eyes on are labor talks. And this is something that Mary Barra talked about in her letter to investors, that basically the forecast for this year is contingent on getting a new successfully signed labor agreement. She seems to have every expectation that they will do so. But it is interesting given the backdrop of contentious labor talks from Hollywood
to UPS
drivers. So, we'll see if indeed it is that assured that they're going to get that outcome.
I asked Paul about that.
Yeah.
I asked him, should investors be concerned that these talks come down to the wire in September when those contracts ultimately expire? He didn't want to answer, of course, because they just started negotiations. But to your point, you're likely to see higher rates, higher labor costs now be factored into GM, which raises the other consideration here, Julie. This is a company still looking for ways to cut costs, maybe by reducing labor over the year.
Lastly, why is the stock down, right? The stock went up after the numbers came out. The forecast
Boggles
looks
my mind.
good.
Boggling.
So not sure exactly what's going on there. But
Totally bizarro. Again, GM this quarter checked a lot of boxes. But be sure to stick around for more analysis of GM's high horsepower quarter. Wow, love that. My interview with General Motors CFO Paul Jacobson is airing today at 9:45 a.m. Eastern Standard Time. We talk earnings, demand for electric vehicles, and the start of talks with the UAW. Miss that interview at your own risk.
All right, we also got to talk about other earnings coming out. Spotify is on that list. The stock is down 5%. Earnings out this morning saw the company's monthly active user growth beat expectations. Gross margins dipping slightly. This comes a day after the company announced price hikes across all 4 tiers of its premium subscription service. Alexander Canal is here with more. My husband this morning sent me the screenshot from his Spotify when he opened it up. I guess I didn't give him the heads up when I knew about that story yesterday. I said, yes, I know. The stock fell yesterday because they did this.
Yeah, and investors seem to be concerned that the price hikes are going to impact subscriber growth, which we have seen has been strong for Spotify. And shares this morning have been on a wild ride since those earnings were released. We saw shares down as much as 12% early this morning. And then they seem to recover somewhat. It's down 6% right now, but there are a few misses that I think is worth noting here. One being that losses widened even further. We had revenue missing estimates due to higher costs and some foreign exchange headwinds. Gross margins, as you mentioned, ticking down. Gross margins, that's been a very important metric for investors when it comes to profitability, so a disappointment there. Free cash flow remained positive, but was also down both sequentially and year over year. And these higher costs are due to a variety of factors, one being how royalty costs have continued to balloon. Spotify also cited losses from cuts in its podcast division. So these are things that are going to play out over the long term. And then in the background of all of this, we have those higher prices, which, as I mentioned, is a bit concerning to investors when they weigh how much pricing power Spotify has in this market. But CFO Paul Vogel did say on the call that the data would suggest historical price increases have had minimal impact on growth, but that they are going to be a bit more conservative moving forward.
Allie, what's disappointing here? Here's a company that blew away the net ads estimates, 36 million. I mean, that was a huge number.
Yes.
So they have 551 million total monthly active users and only produced $9 million in free cash flow. Operating loss, $112 million in the most recent quarter. Awful. Which raises the question, is this a company now that has to get more aggressive in cutting costs? You can get lost on podcasts on Spotify. You don't even know where you find half of the stuff. Do they have just too much content?
Yeah, and that's a big area of concern. They have been trimming their podcast unit. They've parted ways with Prince Harry and Meghan Markle, which was a really big contract there. They're trying to be more strategic in who they partner with, but podcast still remains an important area of growth for this company. They did lay off a significant amount of folks in that podcast unit. They cut about 6% of their total workforce earlier this year. So I do think there's more to be done, especially considering these results. But Steve Keyhall from Wells Fargo this morning said that he's bullish over the long term, that investors just have to remain patient, and that these price increases are going to help gross margins over time. So that's the biggest
You were a fan
thing.
of the Harry podcast, weren't you?
Oh, please. I was going to say, Saz, if you recall,
Okay.
I hate to say I told you so,
Go.
or not told you so, because you weren't arguing against it necessarily, but when they made that big initial push into podcasts and poured so much money into it, I was like, what are they doing? There's so many podcasts. What is their ROI on just saturating the market.
You can't watch. What are you going to put one AirPod in this year and another one listen to the Obama podcast?
Well, you got to listen
Harry,
to it 1.5 times.
and then listen to it on a speakerphone.
No.
No, it's crazy. But they probably have too much content. At what point do they start to, I think, find that Jesus moment where they focus more on profits than trying to drive subscribers?
And I think we're at that point. As you can see with the share price, investors don't have the patience. And I think if we don't see improvement on the cost side through the back half of this year, that's going to be a problem for this company. But they did say 2023 is when they're going to start to improve some of those profitability metrics. But so far,
But the stock has doubled this year.
It is. It's still up.
Because everybody
100%
thinks that
year-to-date.
they're going to raise prices like they just did for $1 and they're going to turn profitable. This report suggests that thesis is completely wrong.
We'll see.
I don't know. It'll be a bumpy back half of the year for Spotify, which, we've been used to with this company. It's up, it's down, it's everywhere. So a wild ride to be had.
Alexander Connell, thanks so much. All right, it's a little different this time around. The majority of companies' out results are beating the street, but they aren't being rewarded with a bump in their share prices. Our next guest says earnings expectations going into this reporting season have not been revised down as much as normal, and the bar is higher. Joining us now is Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Gabriela, good to see you here. Your initial take on earnings season. We're seeing a lot of companies beat big, like GE. Wow, where did that quarter come from this morning? But not really seeing that big pop. What's the problem here?
Great to see you. And I think the problem is expectations. So if you remember the first quarter earnings season, expectations from analysts had been revised down substantially. The second quarter, not the same trend. Actually, earnings expectations have gotten revised less than is what's normal for 5 years, 10 years, 15-year average. And those are analysts. Investor expectations are even higher than that. If we look at a measure of sentiment like the AAII Bull Bear survey, investors are now very, very bullish, the most bullish in 15 months. So I think that's the problem. Expectations are high, so just beating those expectations is just not good enough at this moment.
Well, is the read through there, Gabriele, that the overall market might be overvalued here, and then once these earnings reports die down in about a week or two, we could be looking at a pretty swift summer sell-off?
So I think it does open up the possibility of a pullback. When you have expectations that are too high, the delivery just doesn't quite match up, and then you get a reset in prices, in valuations. What I do think is important to kind of sift through is that we fundamentally believe that the bear market is over. We're now up 26% from the lows. We're just 5% from the highs. We have become a new cyclical bull market. So we're back to just talking about normal pullbacks driven by elevated sentiment, stretched positioning, and a reset in expectations before we get the next leg higher. So we would, at this point, be neutral equities. It's no longer the time to be underweight. It's just taking into account how much expectations have run and not getting too far in your skis either.
I mean, we're talking about, though, I'm sorry, I'm just doing a quick math here. I mean, the S&P hasn't done so poorly since the beginning of earnings season. Yes, maybe individual companies have gotten punished. We're still up about 1%, which is not fantastic.
Yeah.
But we're talking about a little more than a week into earnings. Not impressed?
Not impressed.
And now is crunch time,
Yes,
right? Because
it's
we
true.
do get those big heavyweight tech companies starting to report this evening and over the next few days. And that's where expectations are particularly high already in terms of multiples. They're driven more by the future enthusiasm about artificial intelligence. But even just earnings expectations, there is an expectation that the earnings contraction from last year might be over, that companies have done enough to raise revenue and to cut costs, and that's where we need to see the follow through, and that's what leaves the market a little bit more vulnerable going forward.
So help investors understand this, Gabriela. I know you can't talk specific names, but let's say Apple comes out here, beats by 10 cents, next day stock goes down 2 or 3%. Is that the ultimate sell signal inside of this bull market you're talking about?
Well, I think
short term.
Sure. And I think we have to look at each individual company. Sometimes there is just a silly overreaction to some kind of earnings miss, and then eventually the stock recovers because it's really based on long-term expectations of earnings growth. But for some companies, it might be an important signal that expectations were not accurate. And I think that's especially important for the tech adjacent sector. We were just discussing certain companies like Spotify and Netflix, and this change in investor demand for profitability now. Right, so longer the days of
Spotify being an example, perhaps.
And those kind of companies, just a macro example of the environment has changed. Now that we have positive real rates, investors have other options. It's about which companies are able to raise enough revenue, cut enough costs to become profitable in a 3 to 5 year window, not an eternity kind of window. And that's where we've seen this before after the tech bubble. It's really important to sift through the winners and the losers. Some prices might not ever recover post sell-off last year.
I quickly want to ask about rates too and how that relates back to all of this, because of course, during that sell-off, higher rates were a big concern for tech companies. Now the sort of looking past the rate hiking cycle is one of the things that's perhaps helped tech companies. But does that now become, at this juncture, does that become less important? And this idea of profitability and specific company earnings become more important?
I do think so. I think what the shock was the realization last year that we truly were done with zero interest rate policy and that we were now going back to a regime of positive real rates, and that investors, companies had to readjust their expectations and their business models and had to focus on profitability once again. I think we're now at a point where we understand that, and now it's actually seeing the results company by company. I also think there is this willingness to look through this last rate hike that we expect tomorrow and more focusing on what's ahead, the other side of the mountain, the interest rate cuts and the normalization of interest rates in 2024 and 2025.
I have to give my friends at Barron's a shout out. Good story on their page this morning looking at dividend stocks. So when inflation is starting to cool, some of the best trades or best investments you can make are in high paying, high class dividend payers. Is that the place to look as an investor right now, or do you stay with these momentum names?
We do think income is such an important piece of total return for equities over time. It's not just the price appreciation, it's the dividend. Long term, it contributes about 50% of your total return. When it comes to dividend payers, we think the most important is the consistency of that dividend and not just paying, looking at which company is providing the highest dividend right now, which might be unsustainable. But dividend paying is very, very important. And those tend to be quality companies that are able to maintain that income over time. And I do think the return of dividend paying stocks is aligned with this idea that cash is paying 5.5% now, but eventually we'll go back to more normal interest rates, which we would consider 2.5%, 3%, and then the dividend that these companies pay all of a sudden becomes more competitive, plus the price appreciation, and you get a better total return out of them.
So no dividend for Spotify. Sorry.
So do you start to rotate out of cash or out of some of your fixed income positions into dividends, or is it still a little early to do that?
We do believe ultimately that hard landing or not, interest rates are too high. And expectations for interest rates in 2024 and 2025 are too high. Expectations for 2025 are for rates to be nearly 4%. The neutral rate is 2.5%. So those rates on the short end of the curve need to come down, and that's pretty independent of the cyclical discussion of the economy. So what that means is that actually cash is a pretty dangerous place to be from here on out. It has a role if you need liquidity. It is paying some income now, but it can't be the whole solution. And whether that's stepping into adding duration in fixed income to lock in the higher coupons, benefit from the price appreciation when those yields fall, or whether that's starting to move into more defensive equities, which we would consider income paying or sustainably income paying equities to serve that role as well.
That's really interesting, and definitely a shift in how investors are thinking. Gabriela, stay right there, because we want to shift as well and broaden things out internationally, specifically starting with China, which is pledging support for its economy and giving a big tailwind to the nation's main indices. Tech shares and property stocks both jumping as leaders used a crucial Politburo meeting to flag more aid. They vowed to, quote, elevate stable employment to a strategic goal. That follows disappointing economic data. So what effect is that going to have on those Chinese stocks, and how how should U.S. investors be thinking about this? Gabriela Santos, JP Morgan Asset Management Global Market Strategist, is still with us. We're seeing, for example, some of the U.S. traded China companies that are getting a boost. But, we've talked to some other investors who just aren't that interested in China right now. They don't think that the stimulus is going to be effective. How are you thinking about it?
So I think China is, as always, there's a lot of noise around China. I think it's one of the most important ones to really sift through that noise and figure out the signal, but especially now around the conversation of the recovery. I think it's really important to recognize two things about China's recovery right now. Number one, it's the first time in its history that it's a recovery driven by consumption. Household consumption after 3 years of stop-start, zero COVID policy. So we haven't seen this before. And naturally, it's something that takes longer. It takes longer to get confidence to build, takes longer to get households to spend than a recovery fueled by infrastructure and exports and manufacturing. And the second thing to note is that these days, China's focused not just on the quantity of its growth, growing at all costs, but the quality of it. So it's trying this balancing act of managing long-term priorities with short-term priorities, so structural and cyclical. And I think that's why investors had gotten a bit too enthusiastic about a very, very quick recovery out of China. And now some of those hopes have been a bit disappointed with the April, the May, and the June data. That doesn't mean it won't happen. And that's why we now feel like sentiment is too negative on China. It swung the other way about its recovery, about its earnings prospects, and hence about return potential in its markets. And I think it could be a surprise, a positive surprise for the second half of the year and into next year. Depressed valuations, 10% below average, depressed sentiment, and an eventual return of confidence, of household spending, and hence of earnings. And the Politburo meeting yesterday was a really important step in that direction. A lot of the conversation was around boosting confidence, especially for the private sector and households. And what would really help would be a little bit more stabilization in housing and housing prices.
In the near term, the data has been pretty ugly. So China has slowed down. Those GDP figures, not so great. Europe, I think this week, those PMIs, pretty ugly. Yet this comes as the Dow's eyeing potentially 12 straight days of gains. Should U.S. investors care what's happening in overseas economies right now? Absolutely.
And I think for China specifically, it's the second largest economy and second largest markets, most importantly, in the world. Outside of China, there's a lot of good stuff happening in other emerging markets. Competing with the Nasdaq comes Taiwan and Korea related to a turn in the semiconductor cycle. Comes Latin America, an expectation of rate cuts, fueling flows and fueling a rebound in earnings. So there's good stuff, too, happening when it comes to emerging markets. When it comes to Europe and Japan, we are the most excited in a decade about these markets.
About both of them?
About both of them. Because it's beyond the cyclical, what's happening with second quarter, third quarter GDP. There have been two huge structural changes in these markets. End of deflation and end of negative interest rates. It's huge. Combined with the end of fiscal austerity in Europe. It means you can actually get some okay growth and good earnings growth for banks, for industrials, for commodities. The second big change is both of these companies took a look at what the US does and realized that returning capital to shareholders is a good thing, and it's something that's rewarded in stock prices. So we now have the same buyback yield in Europe and Japan as the US. So that's a huge just corporate governance change. So two big changes, and I think you just need a catalyst to get these, to get Europe specifically going again. But there's very powerful structural trends. And Japan has already been benefiting from that.
It seems like Japan's further along in that process. When is that growth going to be coming for Europe? And what are the contenders for that catalyst?
So I don't think we should, get too carried away about growth in Europe and the actual GDP growth. We're talking about an economy growing about 1.75% in the long run. But it's more the kind of earnings growth you can get in these companies now versus the last decade, and the discount that's still being applied to them as if nothing had changed. And that's specifically around European banks, European industrial companies. It's a very different, much more positive environment for them in terms of their earnings growth, and the discount that's persisted for a decade it just no longer makes sense. The other thing about Europe is there's a lot of growthy stuff in there too, related to growthy themes, whether it's luxury goods around the Asian middle class, whether it's the energy transition, which Europe is very much a leader in, or whether it's related to semiconductors. So you can get both. You can get value, you can get growth, all at a discount.
Interesting stuff. Thanks so much, Gabriela. It's
Thank
great to
you
see
so much for having
Thanks
me.
for coming in. Gabriela Santos
Thank you.
is JP Morgan Asset Management Global Market Strategist. Thanks again. We got much more markets action coming up, including the opening bell. You're watching Yahoo Finance. At the end of this earnings season, will stocks be higher or lower?
Well, the short answer is I don't know. I don't think anybody does. But I think that if you don't get the similar pattern that you saw in Q1, where the bar was lowered so much, then it was just easy to step over for pretty much every company, then you had this pretty miraculous rebound into flat territory, which is impressive when you go from down 5% to no growth, that climb upwards. And I think actually that had that was a big part of why the rally kind of persisted throughout the second quarter. So if you don't get that and you actually get cuts to guidance, which we've already started to see for the rest of the year, my guess would be you probably have some more stumbling amongst the bigger companies and the more high-profile names.
Investors dialing up shares of Verizon this morning after the network operator reported a surprise boost in subscribers in the second quarter. These results come after the telecom industry faced backlash over a Wall Street Journal report surrounding abandoned lead-covered cables. Julie, we mentioned here, of course, that they added subscribers, but you scroll down the earnings release to the total wireless segment, they only added 8,000. So it wasn't some form of blowout quarter from Verizon, but maybe a little better than the past 2 quarters where they were seen as losing market share to a T-Mobile.
Yeah, I mean, again, it's about the expectations, right? And expectations seem to be low going into this. The stock has been falling along with its other rivals within the telecom space, including AT&T. The company did add 384,000 wireless home internet customers. That's better than estimated. So that number is helpful for the company. And I'm seeing some commentary, by the way, on the lead cable investigation that the Wall Street Journal did, the deep dive that it did. We spoke to one of the reporters recently about that. They're speaking about this on the conference call. The CFO saying lead cables are not near customer homes, that the company cannot make what it calls a useful estimate on how much it might cost to clean this up, and that there's more work to do on these lead cable investigations.
File that under hashtag not encouraging.
Right. Well, or just not giving you much information.
Right,
it's very difficult to do.
And, you know, the other side of this trade, of course, is T-Mobile. They're going to report earnings later this week, and they're really not seen as having this lead cable issue. And I think that looks, if you want to play telecom, you want to play slower growth, relatively safer names, maybe that's one of them. They're not playing in this industry or this issue that the journal highlights.
Maybe, but you have a valuation, disparity as well. So you have to consider what's going on there also. But just if you look across, I mean, T-Mobile is not immune to the other things that are sort of affecting telecom. I mean, I don't know their debt position relative to the legacy telecoms, but with rates where they are, all of these companies are having to pay more to service their debt, for example, and telecom companies tend to be indebted. Again, I don't know off the top of my head what T-Mobile
I won't quiz you. I'm not going to quiz you on my team.
No, but do you know? I don't know.
I don't know. I mean, can't know every stat, Julie Hyman. All right, let's from earnings season, let's get the opening bell on Wall Street. Let's do a quick check of the market, sponsored by Tasty Trade. Right now, seeing some mixed action across the board. Dow in the red, S&P 500 in the red, just like you see on the screen there. Nasdaq still in the green, Julie. That Nasdaq trade continues to be really the driver behind this market overall, despite, I would say, negative reactions to, let's say, an earnings report from Netflix a couple days ago.
Yeah, definitely. So, I'm taking a look here at the Wi-Fi Interactive. As you can see, there's the Nasdaq today, but I want to draw it out and look a little bit longer term. This is over the course of earnings season. If you can kind of see it and you can squint and see it, we haven't had much change there. The S&P 500 over earnings season is actually up 1%. So the Nasdaq has definitely been punished by the underperformance of some of the big components within it, Netflix and Tesla most notably. So let's take a look at the Nasdaq 100 and see how some of these companies are doing that are about to report. So here's Microsoft as an example. The shares are up about 0.5%. And Microsoft, by the way, even despite all of the enthusiasm around AI, the company is expected to continue to post sort of lackluster earnings growth. You see here year to date, the shares are up 44%, of course, driven by enthusiasm for ChatGPT and AI. So there's still going to be a lot of discussion about that, of course, on the conference call and questions about it. But then there's the question of how is Azure doing? Are we going to see a reacceleration in that business? So that's really where the company's making its money right now. It's not coming from AI yet. So that's something that people are going to be focusing on. And then likewise, the other biggie that we get after the bell is going to be Alphabet. Those shares up 38.5% year to date. They're little changed as well in today's session. But likewise here, the question that we were discussing earlier with Gabriela Santos is, all of this AI razzmatazz is all well and good and could be helpful in the longer term. In the short term, what's the profitability look like? What does the growth look like? Does it justify 38.5% growth year to date?
Razzmatazz. I have not heard that in a while. I like that.
I don't know where it came from.
Air high five to Julie Hyman. All right, we're also locked in on shares of consumer products giant Unilever, which saw a 7.9% boost in sales in the second quarter as the company reined in price increases. Julie, my day started with this. First, brushed my teeth, got my clothes on, and then I checked our website and saw that Unilever called out peak inflation. And wow, when all is said and done this earnings season, that is probably going to be one of the key takeaways. We saw it in the CPI release a couple days ago, but now it is another thing to see public companies call out, we are beyond the worst in inflation, and that is good for margins.
At the same time, they're not going to stop raising prices.
No, they're not. You can't have everything.
Right? They're just not going to be raising them as much, and they're not going to be raising them across the board like they were before. Some of their food products, some of their ice cream might be getting more expensive. And ice cream, by the way, did not do great relative to the other divisions. It was the slowest growing division.
So price is not melting on ice cream. Have to.
No, not
Aren't
yet.
you so glad I'm here?
And remember, they own Ben and Jerry's. So that's something to keep in mind. Apparently, not as many people are eating ice cream at home. Are you doing your part?
No, I'm actually, over the past month,
don't strike me as an ice
I've
cream
really
guy.
extracted any remaining sugar out of my diet. I'm trying to slim down, maybe getting a little too big for my britches, so I'm really trying to remove that
Literally?
sugar. Yeah.
And figuratively?
Yeah, but you spend a lot of money on these suits, Julie. You know, you got to keep fitting into them. Yeah. Barry's boot camp, a lot too.
You don't go to
No, I go to
Barry's.
boot camp out on Strong Island. You know, I got to stay in
it?
shape. I mean, we're not getting any younger. But I always like your point, Julie. You know, you've mentioned this repeatedly.
Yes.
That it's not
What-
like these.
what
It's
point-
not like
what-
no.
what
It's not like
point
these.
might that be?
No, it's like these consumer companies are going to slash prices. You know, it's like
Right.
yeah, we raised
They're not
prices
cutting prices,
40% on ice cream the past
Yeah.
3 years because of supply chain bottlenecks with cows, you name it, whatever. But we're not going to cut prices by 40%.
Right,
So the prices
right.
are going to stay high in many cases.
They are. And the other thing is that this company still saw sales rise by almost 8%. So the other thing that is important to note here is that they have a new CEO at the helm of Unilever, Hein Schumacher. And so investors are looking for some acceleration in
Quick read
performance
through.
there too.
This quarter from Unilever probably means a good quarter from Procter & Gamble on Friday.
Yeah,
Just saying.
something we should keep an eye on. We like to talk about paint, don't we?
Yes.
We have in the past. Let's talk about Sherwin-Williams. Those shares up about 4.5% today. Again, looking at price hikes there, driving the company to record revenue in the quarter, also raising its full year profit outlook here. So I'm always interested, we've always been interested in this one, and kind of what it implies about housing, about home decor, about spending on those areas. The company said gross margin did improve sequentially and year over year to 46%. They are seeing moderating, they called out moderating raw material costs, which is also interesting.
Yeah, I'm just looking at some of the prices here. On list prices.
Are you doing a little paint
On
shopping?
Sherwin-Williams, I'm blown away. These prices, what, $80 a gallon? What's in this
That's
paint?
only a gallon?
What's in this paint?
Maybe it's some
I
kind
remember
of
it was like
special
$25. My
performance?
dad would drag me to Home Depot for a can of paint. What's going on here with Sherwin-Williams?
That was a long time ago.
I guess it was. Well, Sherwin-Williams, you got to cut some of these prices. Wow. But look, I like what Sherwin-Williams had to say about, I think, recovery in certain end markets in terms of demand, calling out strength in the industrial sector. That was pretty good. Kind of fits with the upbeatness that I heard from General Motors CFO this morning when we talked. That's a good thing as well. And another company, just like we talked about, Unilever, with inflation looks to be beyond peak, and maybe, just maybe, margins will continue to improve in the second half of this year.
Yes, for now. We'll see how long that they can kind of keep in that sweet spot, if you will.
$80 for paint.
Yeah. On a related note, painting your house, maybe you're buying some new appliances. Whirlpool, though, seeing a pullback in demand for its products in the quarter. The company posted mixed results for the second quarter. Sales were down 6% from the year prior to $4.7 billion, and those shares are down about 4.3%. So it just sort of emphasizes that it is not a homogenous view here. When you look at what the consumer demand is lumpy, is what I'm trying to say, depending on what you're talking about.
$800 for a Whirlpool front-loading washer. I think that sounds about right.
$800 sounds
right?
like pretty
good.
like a good deal.
Yeah.
Well, but that's part of the problem, that they're now promotioning again. For a long time, you could not get any kind of discount on any kind of appliance.
Nope.
As Whirlpool has pointed out, the discounts are back, and that's not great for the company. So this is a company that is experiencing margin pressure, unlike some of the others we've been talking about, because it doesn't necessarily have that pricing power. It's leaning into more expensive washers to try to, and other appliances, to get that margin back.
Red flag real quickly in this report, it's Europe. You know, I asked Gabriela Santos from JP Morgan about this. You know, how should investors care about some of what looks to be a new leg down in European growth? We had those PMIs weak. Whirlpool, Europe, very, very weak quarter here. So lots to dig into with that report.
Fun fact, the stuff they sell in Europe, or just appliances in general in Europe, much more efficient
Really?
than what you can get in the US. Yeah, and you get the little combo washer dryer that you put in your apartment. It's not on top of each other, it's the same machine.
It's kind of cool.
Yeah, That's cool. We're going to talk to the CFO of Whirlpool. That's coming up in the next hour about all of this. Always a really fascinating insight into what's happening broadly.
Jim Peters is my forward-looking indicator on the economy. I mean, this guy is on the pulse of his business. All right, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance Live.
How would you describe the consumer right now?
I would say the consumer is bending but not yet breaking. When you think about the bend, certainly excess savings have been spent down pretty much when you look across all income quintiles. When you look at 401k hardship withdrawals, we're getting anecdotal evidence that some folks are tapping on those to potentially fuel some of their spending. But they're not necessarily breaking, right? They're still spending. If you were to look at, we talk about revolving credit debt in aggregate, and I know the number is a scary number, but if you look at it as a percentage of disposable income, it's actually below where we were prior to the financial crisis, and it's creeped up a little bit, but roughly where we were at just right before the pandemic. So I think we're seeing a normalization in credit usage, not necessarily consumers coming overextended. So I would say consumers are bending, but not yet breaking at the moment.
GE is getting a boost after the company raised its full-year outlook as results beat the street. Strong demand for jet engines is a big part of the story here. GE's aerospace unit saw a 37% rise in orders as it recovers from the pandemic lows. Brian Langenberg of Langenberg and Company Principal joins us now. Brian, good to see you here this morning. Look, I think investors have only known GE the past 3 years to be an outright dog, but you pull up this earnings release, you have total orders, organic orders up 58%, and they're raising the top end of their earnings guidance by 30 cents. What in the world is going on here?
Well, it's no longer a dog. The stock is, finally started to act well over the last year or so. And there was a period of time much longer than 3 years where the wool was pulled from everyone's eyes. I mean, going back over a decade. But once Larry Culp came in a few years ago, those of us who had known Larry before he was Larry knew that this was going to be a fix. It wasn't going to be a quick fix, wasn't going to be any kind of overpromise, underdeliver, and that he would take a methodical approach to what needs to happen at the company. And that's what's happening. Now, in terms of the orders, aerospace, demand is demand. The Paris Air Show is extremely strong. Everybody is getting orders. So, they obviously benefit from that. But also, if you think about it, as they break the company up and they spin it off, you don't do that spin until you can provide some good results, some good tailwind, pun intended, for the major business units. So, I sound like a little bit of a cheerleader here, but it's everything that the top line would suggest.
And to your point, we've got the spin coming next year for Vernova, as they have dubbed it, which is power generation and renewable energy. So how should investors be thinking about, we also, by the way, had GE Healthcare report. How should investors be thinking about the various component parts here and what is most attractive, or which asset has what attributes that they should be aware of?
Great. So the premier franchise of all of these is aerospace. Okay. The healthcare business is also very good business. That's pretty much being spun. But the aerospace asset is the key asset. When you took a look at something, I wish I could have a job just being paid to come up with these stupid names for new companies. I'm just telling you.
Well, you don't like
whatever.
Vernova, Brian? Vernova's kind of cool, no?
I don't know.
It's not.
Vernova,
I don't care.
Vivendi, Mondelez. We have a nice list of these kinds of things.
This is nothing new.
Right.
This is nothing new. A little segue into aerospace. Textron was a textile company in New England. And somewhere in the late 50s, early 60s, someone said, if you put a Tron on it, you'll get a higher multiple. So this is nothing new. But in terms of more substantive analysis.
Maybe Larry Kolb. Hey, Larry, if you're listening, GE.AI. Maybe that's the way to go.
Yeah. Well, the thing is, he's a leader. He's not a fad chaser. And that's, fad chasing is what dogged the old General Electric. Blocking, tackling, pursuing excellence is what you have now. So to come back to your question, aerospace is the best franchise of these. You start talking about power and renewable. Obviously, large franchises, are they as attractive? I don't think so. But they're good businesses, and by themselves, they can pursue their own strategies. And the nice thing about when a business has been locked in a large conglomerate for a long time and had underachieved for a while is, when a business is on its own, whoever's running that business has to answer to the whole market, not just a corporate. So it's a positive development for all those businesses. I think aerospace is the best one of the three. But they should all do better on their own.
I want to turn to another conglomerate that is more in a challenged place right now, I think safe to say, and that is 3M. The company is just overshadowed with legal liabilities, both from the so-called forever chemicals and from some military stuff as well. That said, they beat estimates. So, it doesn't seem like it's a free and clear situation here, but investors seem to be happy about the numbers today.
Yeah, they're happy about the numbers today. And just stepping back on 3M, 5 years ago, 4 years ago, 3 years ago, this was looked at by the street, including myself, as just being a premier company, very well-run business, outstanding in operations, and really what they are is a specialty chemical company on steroids for the most part. And they've always been very good at make it by the inch, sell, or make it by the mile, sell it by the inch. And if you go in the facilities, the way they run them, they really focus on that. But you always had a lawsuit here, a lawsuit there. And I'm not a legal analyst. I don't know of anybody that got on the legal thing early and said, wow, this is going to blow up. But it did. Okay. So to frame this, if you pretend for a minute there was no legal issue or nothing had come up, this is a company where the stock should be worth at least $200 million. Now the talk is around about up to $20 billion of total liability. There's some bid asked around that. Well, that's $40 a share, $40 a share. So take that 200, subtract $40, you still have intrinsic value of about $160. So are you going to get that today or tomorrow? No. Think of 3M as a beauty pageant winner that's got some mud on her, and you got to account for it, but she's going to come out of this. Okay? That's how I see this playing out. It's going to take a while.
Those words, Brian, not mine. Before I let you go, as someone that has a lot of
I am my own HR department. So.
As someone that knows a lot about industrials, now that we got GE, now that we got 3M, what is your favorite stock to own in industrials?
at this exact precise moment, and I have a hold rating on it, okay? So this is not a ratings change, but, they told us, oops, we got a problem with some of our engines. It's going to cost $500 million. And at this precise moment, the market has taken about $19 billion out of the market cap. So $500 million problem, $19 billion out of the equity market value. Now, if there's another shoe to drop, obviously that analysis has to get modified. But I'm just looking at that and going, unless Pratt & Whitney has forgotten how to build aircraft engines, might be a bit of an overreaction.
All right,
Otherwise, the only other name I focused on is Boeing, and it's simple math. Their commercial aviation or commercial, and aircraft had gone from 60 billion in revenue to a low of under 20 billion. And when 60% of your sales are going to triple over the next few years just to recover to where they were, that can't not work.
Really helpful analysis on a busy morning, Brian. Real good stuff here. Brian Langenberg and Company Principal. Good to see you. Talk to you soon.
Thank you.
All right, General Motors is out with its second straight full-year guidance raise. The hike comes after strong second quarter results powered by trucks and SUVs. I talked with General Motors CFO Paul Jacobson about the guidance increase quarter and the road ahead for EV production.
When you look at the momentum in the business, really nothing has changed from what we said at the very beginning, which is a strong consumer demand for our products, resulting in really good pricing for us across the board. When you factor that in with our cost-cutting measures and some of the early returns on that, you get a quarter like we put up and an opportunity to raise expectations, which really, really proud to do on behalf of all of us here at GM.
Paul, is this yet another quarter where the power of selling more trucks, those higher margin trucks, really shows itself?
That's exactly right, Brian. At the end of the day, it's really about the quality products that customers demand. And what we've seen is our customers can't get our trucks and our SUVs fast enough, including the higher trim models. When you look at the Sierra Denali and the Tahoe premium vehicles, about 75% of them are selling at higher end premium trims. So customers have responded with loving the products and willing to pay for them. And that's what's resulted in these fantastic outcomes that we've seen.
How do you explain this to the average Joe out there, these results, Paul? And by that I mean the economy isn't rip-roaring. Nobody's celebrating slower economic growth. This isn't a late 1990s type of economy where things are hot. But here's GM, strong results for higher priced products year over year.
Well, I think, this is still a little bit of a factor of some of the pent-up demand that we saw from 2020 and then the chip shortages in 2021 and 2022, where, customers really love their vehicles. And, it's an incredibly important purchase for them. And it's one that they budget for and they make sure that they can fit in because it's really a reflection of their lifestyle and what they want to drive. So we've seen that continue with those demands. In fact, over the last year, we've actually created a higher trim level in response to that customer demand with the Denali Ultimate. And that's an opportunity for us to go in, identify what customers are looking for and create a product that they're willing to pay for. And we've seen that. So, it doesn't happen without quality. It doesn't happen without knowing what your customer is looking for. And that's where I'm incredibly proud of the GM team.
So General Motors hit its first half goal for EV production, 50,000. How many EVs will you make in the second part of this year?
So we're still on track for 50,000 in the first half and 100,000 in the second half. Our Ultium production is ramping up very, very quickly, as we've seen. At the end of June, we had over 2,000 Lyrics and Hummers that were in transit to dealers. And, as we know with our products, once they hit the dealers' lots, they're sold very, very quickly. In fact, we've got pre-orders that we're still fulfilling. So we're gonna about double EV production in the second half of the year and continue to scale up from there. So the momentum is building. We've known this for a little while now. And that momentum, when you combine it with the tangible results, I think is a great story for investors as well.
What's the pricing outlook on those EVs? Because there's been a lot of focus on price cuts in the EV space. Your competitor Ford out there cutting prices in large part because of what Tesla's doing with its own prices.
Yeah, we're very comfortable with where our products are priced, and when you look at the demand that we've seen and the order books that we've built, our biggest challenge right now is we can't get the vehicles to customers fast enough, and we're working on scaling that pretty quickly. But we've been very consistent about pricing to where our demand is. I think when you change pricing that dramatically, that fast, you create confusion in the customer's minds. And I don't want to be the person who bought an EV the day before you lowered the price by $10,000. That's not a great way to manage customer expectations. And that's why we've been consistent. We've seen this happening for probably pretty close to a year around EVs. And while we're ramping up production and fulfilling orders, our customers have told us that we believe these vehicles are fairly priced. So we're going to continue to do that and make sure that we're responding to where the demand is.
What's the vibe inside General Motors, Paul? Is something like the Cybertruck, is that a true competitor to the Silverado EV?
Well, when you look at the Silverado EV and its capabilities, 40% more range than anything else that's out there. We're very confident in what that is. I think what we've got to do is just keep our heads down, continue to execute, build what the customers are looking for, and we think the business results will speak for themselves. So our team is all in on really driving those production rates higher. And I think when you start to see that Silverado EV in our fleet customers' hands first, you're going to start to see some testimonials that really differentiate it from anything else that's out there. And we're excited about that.
Since we last spoke, big deal between General Motors and Tesla on the supercharger front. As the CFO of General Motors, what type of financial impact is baked into your financial statements from a deal like that, if any?
Yeah, well, there's nothing very specific that you can point to in the financial statements. But when you think about the capital journey that we're on, not just for GM, but for the entire industry, you want to try to streamline where you can. And where we see an opportunity in the partnership with Tesla is, we immediately double the number of available chargers that are there for our customers going forward. But most importantly, we focus not just for our customers, but for the industry as well on a more efficient solution across the board. So we're not building competing charging sets on opposite street corners in every intersection. And these economies that are going to result from Tesla, from GM, from Ford, and others that may join in the future is going to result in a much more streamlined experience for customers all over the place.
CEO Mary Barra, General Motors, of course, really highlighting her shareholder letter on the earnings release, Paul, more cost cuts could be happening. What is your overall cost cut goal now, and where do you think those cuts will come from?
Yeah, so we announced earlier this year a $2 billion cost reduction program. We had a voluntary severance program, and we had over 5,000 people choose to depart or retire early from the company, resulting in about $1 billion of run rate savings going forward.
That was the CFO of General Motors, Paul Jacobson. As we all know, the company released its second quarterly earnings, seeing strong revenue and profit beat. The automaker also upped its profit forecast for the second time this year. Yahoo Finance's Prasad Subramanian, who has been listening into the conference call to give us some more details here.
Yeah, you just said it there. Revenue up 25% there year over year, $44.7 billion, $1.91 adjusted EPS. GM upping that profit guidance for the second time this year, talking about how extracting costs and sort of higher MSRPs helping to boost that bottom line. Here is Mary Barra talking about that just earlier today.
We have now delivered 4 consecutive quarters of higher retail market share in the U.S., and our total share was up almost 1 full point in the first half, with strong pricing and incentive discipline. We lead the U.S. industry in both commercial and total fleet deliveries calendar year to date. We now have led the U.S. industry in initial quality for the second year in a row. We are focused on strong cost discipline, and we are taking additional steps to lower our capital spending. All of this impacts the bottom line, so we are raising our full-year earnings, free cash flow, and EPS guidance for the second time this year.
So they're finding a lot of that cost extraction through these layoffs they had announced before that they call the sort of voluntary buyouts, and then also stuff like marketing costs, travel costs, things like that.
And what's the vibe, Praz, around electric vehicles? Because we heard GM this morning call out They're going to make 100,000 EVs potentially in the second half of this year, bolt on to the 50,000 they made in the first half. 150,000 for a company that was struggling to get these to market. It's not too shabby.
Yeah, I think there was a little bit of a hiccup there because they talked about how they hit 50,000 EVs this year, first half, 100,000 next for the second half of the year, and then eventually 400,000 by the end of 2024. But I think there's some concern about the battery modules and getting those up to speed. Mary Barra addressed that, and she said it was kind of disappointing to see that ramp up.
We've also added additional lines because we don't want module production to gate our launch of all the products that we have coming in the second half of this year and continuing into next. And we know we're going to need that module assembly capability anyway as we continue to grow beyond the 400,000. So disappointing. I've personally been reviewing the lines. As you know, I spent time in ME earlier in my career running it. So we'll get this behind us. I'm very confident of the teams we have in place. You'll see it improve as we get through, I would say, into the end of third quarter, beginning of fourth quarter, and then I think it will primarily be behind us by the end of the year.
So some bad news, but good news. The Chevy Bolt's coming back. They announced that.
Is that good news?
I mean, it is their by far and away top-selling EV, right? So it's going to come back as a next-gen model using the Ultium platform. So that's going to be there. And I think all eyes are on them to execute for the next back half of the year with the Silverado, the Blazer, and then also the Equinox coming out too.
All right, well, I'll let you get back to the call. Good stuff. Prof. Subramanian. Appreciate it. All right, more analysis of today's market action straight ahead. You're watching Yahoo Finance Live.
What sector of the market do we not pay enough attention to?
Consumer cyclicals. I think we want to know where the economy is going. That's one of the best ways to find out where people are spending their money on. Discretionary purchases, so I guess consumer discretionary as well. Let's see where those are going, and that'll tell you a lot about how the consumer, which is 2/3 of the economy, is going.
Just after 10 a.m. in New York City, this is Yahoo Finance Live. I'm Brian Sazzi alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving on what has been a very heavy earnings morning. Stocks in a holding pattern ahead of mega cap tech results from Alphabet and Microsoft later today. Investors also keeping an eye on tomorrow's Fed decision and the path of rates this year.
And shares of General Motors, we're watching them down this morning, even as the automaker issued its second straight full-year guidance raise. The hike coming after strong second quarter results powered by trucks and SUVs. The shares were higher, but they have turned lower.
Shares of Danaher Corporation, a medical and industrial manufacturer, on the up this morning despite weak guidance for the year ahead, mainly due to lower COVID-related revenue, overshadowed better than expected financials. Shares of other rivals in the life sciences space took a hit as well on the dour forecast.
Yeah, and that's another one that turned around. It had been lower earlier and is now higher. So a lot of shifts here. Also, let's look at F5, a cloud security company. Revenue there and profits beating estimates in the second quarter thanks to a rise in client spending on technology. The shares up nearly 8%, and the beat comes after the company lowered its year-ahead outlook in the previous quarter, citing macroeconomic headwinds and reductions in workforce. We've got some breaking news that just came out a few moments ago. It is the Conference Board's read on consumer confidence for the month of July, coming in at 117, which is considerably better than the 112 that was estimated. The present situation index at 160 and expectations at 88.3. So this is the latest read that we've gotten on consumer confidence that is coming in stronger than estimated, and just kind of, underlines what we're seeing among consumers.
Lots of interesting reads for the consumer, Julie. Of course, this coming in better than expected. General Motors out today with its earnings in large part powered by human beings willing to spend more on higher priced vehicles, not just cars, it's SUVs, it's giant trucks. You go back to last week, you had Netflix. Despite higher prices for Netflix services, people still holding on to their subscribers. You go back even before then, PepsiCo with its earnings, strong quarter for them. The consumer, by and large, despite a lot of headwinds coming at them, appear to be doing well.
Yes, but it's not uniform. This, by the way, this reading is a 2-year high for consumer confidence, at least this conference board reading. We, of course, have the University of Michigan readings that we watch closely as well. Retail sales were not so hot, although there were segments of retail sales that were quite strong. Department stores, not so much. Gas stations, not so much, but other areas, yes. So it's not, again, there is not a uniformity here. Whirlpool, another example of something that is not seeing a strong demand. So I'll use the word lumpy once again.
I like lumpy. Okay, it's really good.
I'm glad.
All right, moving right along. As an uncertain economic environment leads to elevated layoffs in several industries, many Americans are wondering what this means for their employer-sponsored retirement savings plans. Yahoo Finance senior columnist Carrie Hannon joins us now to explain your options. Carrie.
Well, hello. There are some options. It is, you basically have 4 options, right? And the first one, let's not do this one, cash out. And that 1 out of 3 workers cashes out. It opens the door to this invitation to take your money out of your retirement plan. This has huge repercussions. You pay tax on it. You pay a penalty.
1 out of 3 people do that.
Yeah,
wow.
And younger people more. And trust me, I did that when I was 30. And it's the biggest financial mistake I ever made when I think of what that would mean today. So that's number one thing. Try not to do that. The other 3 are much more preferable. Number 1, you can leave it right where it is in your current employer plan. So you don't have to make any rash moves. But this is something that if you like the retirement, the options, your investment options there, you can do that. Problem here is you can't add more to it. So it's there. The second one is you transfer it over to your new employer plan. You need to talk to that plan administrator and see if you can do this. That's a nice direct transfer. If you like the options there, good opportunity. It consolidates your retirement accounts so they're all in one place, hopefully. That's one option. The third option, which I think most people do at this point, is you do a direct transfer to an individual retirement account at a financial institution, an IRA. So what happens there is they help you. The company will help, the financial institution will help set that up for you. You do a direct transfer, you have your own IRA, it gives you a lot more investment options, and you have control of it. So those are the basic ways to do it. There are a few caveats. If you are going in, you may end up paying higher fees with an individual IRA than you would if you kept it in an employer plan. That's simply because they can negotiate lower fees as a big institution. The second thing is if you're not quite vested in your employer plan, which means their contribution isn't the full amount that you expect, you may not get all of that vesting transferred, or you may get none if you haven't met that vesting thing. Something to remember. If you have a Roth 401k, you need to transfer that directly to a Roth IRA, whether you already have one up and running or if you need to open a new one. But it's got to go into a Roth And finally, just keep in mind if you have a small account, if you're under, it's going to be $7,000 next year, but $5,000 for this year. Your employer, if you do nothing, your former employer might just put it in an IRA in your name, and it's really easy to lose track of that. So you don't necessarily want that to happen. If it's under $1,000, they may just cut you a check. If they cut you a check, you don't want that. They're taking the taxes out and you're paying the penalty. So those are the basic sort of the lay of the land.
Really, really helpful information. And not, by the way, just if you get laid off, also if you switch jobs. These are various things to consider.
Absolutely.
Thank you so much, Carrie Hannon. Really appreciate it. And sticking with retirement, that big subject and scary subject for so many. As the current economic environment remains uncertain, so does Americans' view of their own retirement planning. A new study from BlackRock found that only 56% of Americans say they feel on track for retirement. That's an 11% decline from 2022. For more on this report, we're joined for an exclusive interview with Ann Ackerley, the head of BlackRock's retirement group. And obviously, BlackRock is a huge player in retirement with a huge reach. And it's great to see you again. Thank you so much for coming in.
Thank you so much for having me, and so glad to be here to talk about retirement.
That number is alarming, right? Only 56% of people think that they're on track. What do you think is behind that unease, and especially the big change year over year?
Right, so we've been doing this survey, Read on Retirement, for 8 years, and this is the lowest it's ever been. As you said, only 56% of people, American workers, think they're on track for having the retirement they want to have. And in particular, we saw this enormous drop in Gen Z. So what's driving this? Well, it's really the market environment, right? There's been market volatility, inflation. People are concerned now about running out of money. I think anybody who lived through last year with both stocks and bonds being down, it was just a really hard year. And I think people are reflecting that in terms of their confidence in retirement.
How can one get back on track? What steps do they need to take?
So great question. One thing, and there was some good news in the survey that we did, workers did not reduce their contributions. So one of the most important things during this market volatility, these hard times, is to keep contributing. And we actually saw that people did that. Instead, they maybe didn't go on vacation, they maybe didn't buy a large item, so they reduced their spending so they could continue to contribute. One thing I would want to call out, so that was really good. Two things I would say is, one thing I did think was disturbing, when you looked at Gen Z, again, our youngest workers, 60% said they might consider selling during a market downturn. Only 20% of baby boomers said that. I would say to those Gen Zers, don't sell. You got to ride through this. You know, they just haven't lived through as many market cycles as maybe some more experienced older workers. So please, please, please don't sell. Ride through it. Continue to contribute. Continue to dollar cost average. When we turn to baby boomers, 36% of them said they were considering delaying retirement. So you ask, how do people get on track? You know, in an ideal world, people would retire at the age they want to. But given this market volatility, it may not be the worst thing to think a little bit about delaying retirement, if they can, not everybody can, continuing to earn some money and not spend. And maybe if you delay retirement, you can even put off taking Social Security, and that will ultimately increase your Social Security payment as well. So there are things people can do to be back on track. But we need to realize this is a tough time for people with respect to retirement savings.
I mean, it's so interesting, too, because the last 2 years have illustrated to people the value of hanging on, right? Because last year was down, but this year a lot of that stuff has come back. Yeah. One of the other interesting things that stood out to me in the report was the bit about guaranteed income solutions, which sort of harkens back to the pension days, right? To guaranteed pension days. So are there more options now that sort of mimic that effect, that you know the money is going to be there, at least some portion of it?
So what I would say is savers, workers are asking for it. 90% of savers would like to see some form of guaranteed income in their 401k. And we know that employers are beginning to look at this.
So just to back up for 2 seconds, what does guaranteed income mean? What do people need to know about it?
Sure. I mean, in a sense, it's an annuity, right? Now, I know people don't like annuities. They think they're high-priced or they're complex. What is happening in the 401k space is there's been a lot of innovation, and pricing of annuities has come down. You can make them much simpler. And so the concept would be that within the 401k, you would have an option to choose for some part of your savings to buy an annuity. It might even be embedded in the target date. And so savers want it, workers want it. Employers are beginning to think about it, and we are starting to see some employers add a form of guaranteed savings into the 401k.
What are some of the biggest questions you've been getting from folks right now on retirement?
Sure. I mean, the number one thing, right, is how big does my nest egg need to be? You know, what does that nest egg, what will it earn in retirement, right? How much will I be able to spend? So that's a big range of questions. I'd also say just basics. People, and this is 71% of Gen Z, said they didn't know enough about investments to feel confident within their 401k. Now that's 50% of baby boomers, so maybe again with a little wisdom you learn a little more. But even the basics of what do I invest in, workers want advice and education, and they want it from their employers.
And are more employers offering that kind of advice?
Yes, 100%. 98% of the employers we surveyed said they feel responsible for their employees' financial well-being. And yes, we're starting to see more programs around financial wellness, more education, and I would just encourage employers in this kind of volatile time, you know, the down and the up and inflation, education, advice, offer it, you know, short videos on your internet. People are really looking to their employers for this kind of advice because they trust their employers.
Really interesting stuff and important stuff.
Important stuff.
For a lot of people. I love this report when we get it. It has really good insights. And I love seeing you. Thanks for coming in, and I appreciate it.
Thanks so much for having me.
Ann Ackerley of BlackRock, appreciate your time this morning. We've got much more markets action coming up. You're watching Yahoo Finance. Will markets be higher or lower at the end of earnings season?
I think lower, at least if today's any indication. Netflix, Tesla. We had very high hurdles to jump over, and so far they're not. The banks, which had low hurdles, are jumping over them. So in general, with the valuations we have, probably lower.
We got a quick check of the markets for you, sponsored by Tasty Trade. All three major averages in the green. The Dow just barely, so that makes it what, 12, 13 days in a row?
Losing track.
Losing track at this point with this rally that we have seen for the Dow. The S&P up slightly as well. The Nasdaq gaining 0.5%. A lot of earnings movers today that we have been sifting through. Here's one of them. Consumers pulling back on purchases of home appliances. Whirlpool saw weaker demand for its products this quarter, despite signs of inflationary pressures easing. The company posted mixed results for the second quarter, beating adjusted earnings per share expectations. Sales, though, falling 6% from the prior year to $4.7 billion, just shy of analyst estimates. Joining us now is James Peters, Executive Vice President and Chief Financial Officer at Whirlpool. Jim, it's great to see you. We love checking in with you to talk about what's going on in the world of appliances. I just want to start big picture with what you guys are seeing in terms of demand. Talk me through it.
Yeah, and good morning. Good to be with you guys again today. What we're seeing in terms of demand, you could probably break down into three different buckets here. And if you think about our business, there's a big part of it that's replacement, and that's 50 to 55% of the appliances we sell. And that segment is relatively stable and strong and pretty predictable. The next part is what we'll call discretionary spend, and that's about 30% of our business or 30% of the industry. That's the segment right now that I would say the consumer is still relatively tentative in. And part of that is driven by existing home sales are still relatively low. And if you think about it, when people buy an existing home, one of the few things they do change out when they move in might be the appliances. So that segment right now, we would say, is below where we expected, but is relatively stable. Now, the last part of the industry in our business, which is about 15% for us, is new home construction. And we're beginning to see that pick up. And I think you've seen in the last couple of weeks, a couple of the large builders come out and be rather positive. And we're seeing the same thing. We're beginning to see their business pick up, which means in about 6 months, our business picks up as those homes are completed. So, as I said, it's probably a mixed bag on demand within the U.S. And then if you go outside the U.S., part of what impacted us within the quarter is that demand in EMEA was down by about 10%. And that's just the macroeconomic environment there and lower consumer sentiment. But as I said, in the U.S., we are positive on the demand in the future, and we do believe we'll begin to see some of that pick up. And with people who can't find existing homes, many of them will turn to remodels at some point, which then falls in that discretionary bucket for us.
Jim, it's Brian here. Good to see you as always. How fast will that rebound in the U.S. housing market take place? This week, we're supposed to get what could be the last interest rate hike for this cycle from the Federal Reserve. What does that mean to the next 6 to 12 months in the housing sector?
Yeah, no, that's a good question. Like I said, we're already seeing the signs of new home construction pick up as, people who are in the market for a home and couldn't find an existing home due to low inventory. And the reason there's low inventory, as many of us know, it's with mortgage rates where they are. Nobody wants to give up on their, 2.5%, 3% mortgage to take on a 7% mortgage right now. So we expect to see that pick up in new home construction, over the next 6 to 12 months. I think then as you look to next year, we would expect to begin to see, as interest rates stabilize and it's kind of been absorbed and normalized within the marketplace, you'll begin to see some of those existing home sales pick up. But, right now, I'd say new home construction will be the first thing to show signs of growth.
And Jim, for the people who are buying new appliances, what kind of choices are they making? Because I know you guys have, you've been doing more sales, more promotions, but at the same time, you've been leaning into some of your higher end stuff. I know you guys bought InSinkErator. I am an InSinkErator owner myself with a kitchen reno that I did. So how many people are making those higher end decisions right now of your customers?
Yeah, I would say, the mix, and first off, thank you for buying InSinkErator, but the mix of our customers we see right now is relatively stable and pretty much in line with what we saw, historically and especially pre-COVID. Now, as I mentioned, as new home construction picks up, what you do start to get is a disproportionate amount of kitchen appliances because every new home takes on average around 5 appliances, the majority of those being kitchen appliances. So, that's the categories that we expect to see pick up. I'd say right now, though, our balance of sale or our mix of product is relatively similar to what it had been in the past, as well as our mix of brands. We still are seeing the consumers buying in the premium space and also in the mass space. So despite the fact that the promotional environment has returned to levels that we would have seen before COVID, I'd say, consumers are still buying at that premium and especially that mass premium segment right now.
And Jim, I put this question to General Motors CFO this morning, and I'll put it to you. Do you think inflation has peaked for this cycle? Are you confident that you can say that?
I would say, listen, from a material cost perspective, we saw the peak probably late last year. And if we look at other costs, our logistics costs have come down. I'd say labor is the one cost that, what I would say is that inflation is probably steadied there, and it's at a more typical rate. Obviously, I don't think labor costs will come back down, but we have seen, we talked about our material costs for the year. We saw about a $300 to $400 million deflation in our total material costs. And in our logistics costs and other things like that, we saw similar levels of deflation. So I do believe, at least for our business, when you take it in aggregate, inflation has peaked. But if you break it down among the components, there's still a few areas where we are seeing some inflation.
One of the things that always has amazed me, Jim, and I used to cover Whirlpool as an analyst more than a decade ago, is the management team's ability to always find cost savings somewhere in large quantities. So this year, how much will you find in terms of cost savings, and then what's left for next year?
Well, right now we're targeting and we expect to deliver about 800 to 900 million of cost savings. Now, as I said, the first 300 to 400 of that is just raw material deflation. Then when you look at our products, within our products, as we launch new products all the time, we have the opportunity to just look at how do we take material cost out of the product, use different components, develop it in a different way, different engineering specs, whatever they are. Then additionally, this year we've talked about is that we've been able to reduce our headcount, our overall headcount, by about 7%. We didn't do any big layoffs or reduction of force. We just managed our attrition very well, which allowed us to bring those costs down. So, and then I talked about logistics costs coming down, and we continue to optimize our logistics network to try and, bring those costs down even further. As we look forward to next year, I think we see next year as a environment that we can continue to reduce our costs within. And typically, we've talked about on our earnings calls that in just any given year, taking costs and inflation to be relatively stable, we still would target about 0.5 point to a point of cost reduction within our margin walk. And, that's at least what we see as we head into a new year. Right now, it's a little bit early to predict, what the market might be from materials and logistics costs and other things. But I do expect next year to be another year of cost reduction for us.
Jim, I want to turn to the innovation front before we let you go, because just a small thing, we were showing some video, washing machine where you can take the agitator out to fit different stuff in there, which is a small thing, but exciting from a laundry perspective.
Oh, that's cool. No, that's cool.
Sure. I'm just curious what you're most excited about on the innovation front, what you're seeing, what new products you're coming out with that you think consumers are going to be excited about as well.
Yeah. Well, and I'd say, this year we did launch our Maytag pet line, laundry line, which really what it does is adds a filter in that you can just rinse out when you're done, but it collects pet hair. And I think that's one of the things we've seen consumers most excited about, because if you think about during the pandemic, a lot of people went out and added a new fuzzy family member or two to their household. And, now they're going through the issues of having dog hair or pet hair everywhere. So, that's one of the things that we've been very excited about this year. We continue to be excited with the dishwasher that we launched, in the last couple of years that has the usable third rack, or the third rack that has fully functioning wash system on it. So those are just some of the examples of some of the products that we are excited about right now. But, within any given year, we typically launch over 100 new products between both our major domestic appliance line as well as our KitchenAid countertop line. So, I would say that just on a regular basis, if you think about that, it's about 25 products every quarter. There's a lot to be excited about.
Jim, are you trying to say here that one should not take their furry puppy coats and putting them in the washing machine? Julie, what do you do with Sparky's clothing? What do you do with it?
Sparky doesn't wear a lot of
clothing.
but he's a shedder. So, like, if I could throw his doggy bed in the washer and have the pet hair filter, that would be helpful for
Every
sure.
day is eye-opening. Let's leave it there. James Peters, Executive Vice President and CFO, Whirlpool Corporation. Always great to get some time with you. Appreciate it.
Great. Thanks a lot, guys. Have a good day.
You as well. All right, we'll be right back with more stock market analysis. You're watching Yahoo Finance Live.
Why aren't we in a recession yet?
So that's a complicated question, but I think there's a big bed of liquidity that the tightening of financial conditions is still kind of chewing its way through. That bed of liquidity was created in the pandemic through fiscal transfers, excess savings, and so the lag effect of monetary policy tightening is taking longer than a typical cycle has.
Steel giant Nucor blew away profit estimates today on the back of strong demand from auto and other industrial end markets. CEO Leon Topalian told me. Here's what Nucor's top leader says about his company's longer-term outlook.
You know, Nucor's continued position for growth is in our platforms for our investment and capital allocation or paying dividends for our shareholders. You know, we earned $5.81, as you know, EPS for the quarter, $10.26 for the year. So it's our second strongest start of any year in our history. So again, with all the looming fears and talk about recessions, Nucor continues to take care of our shareholders, our customers, and our team. Brian.
Take us through this earnings report, Leon. What stood out to me, steel mill profit margins up. Why would that be the case?
You know, again, underlying demand continues to be very resilient. So we're seeing sectors like automotive, energy, within oil and gas, renewables, the advanced manufacturing, data centers, all continue to be areas of strength. And Nucor is one of the most diversified steel producers in North America, is well positioned, well poised to capitalize on that. And again, you're seeing that kind of flow through in our earnings portfolio, free cash flows generated, EBITDA generated. And that, you know, again, is a part of a long-term investment strategy.
Within those industries you just mentioned, where are you seeing some of the strongest demand? And are you seeing any signs of slowing anywhere as it pertains to the top line?
again, thinking about Nucor's breadth, right? We're the largest steelmaker in North America, the most diversified. So there are parts of the portfolio that are not as strong as the 2020 peak years. But again, 2022 is it has to be viewed through the lens of context. So it was the peak year, record highs across the board. And so, for example, in warehousing, still very strong, but off 15, 16% year over year. However, pre-pandemic, it's up 60 or 70%. So again, the segments of that remain incredibly resilient, but automotive continues to be very strong. The advanced manufacturing in our warehousing data centers year over year are predicted to be up. So we're seeing that renewables, offshore wind, oil and gas continues to be an area of strength. So those are the markets that, again, are showing signs of improvement or strengthening.
Within your outlook for this year, Leon, do you see a rebound happening in the U.S. housing market?
You know, that's a great question. And like everyone else, we continue to watch. And, you know, when we started 2023, all the pundits were talking about the recession. And again, we'll see if that comes or not. But GDP forecast in Q1 was predicting a Q2 GDP of 0.3, obviously much, much stronger. I think that continues throughout the rest of the year. How much of a rebound we'll see, you know, I don't want to predict right now. But again, I think there's some consumer spending continues to be strong. And so we're seeing sectors of this economy that remain very resilient, on top of which there's another aspect of that we've not seen, certainly in my time in steelmaking, and that is the amount of money being put into this economy through legislation. The CHIPS and Science Act, IRA, infrastructure are things that in spite some interest rates and some, again, talk of a recession, remain incredibly robust and are bringing things into our sector that, again, Nucor is well positioned and capitalized to execute on.
No, you brought up some very good points, and I want to get to that. But in terms of just the costs of doing business, are you confident in saying that inflation has peaked? We're hearing that tone start to emerge this earnings season. I think a lot of investors haven't heard that from CEOs in 2+ years. Can you say that?
You know, look, I would tell you that we're a margin business. And so at the end of the day, we're not immune to some of the influxes of the supplies and services, but most of our uses are coming within the United States or certainly within North America. So we did not have the exposure to other nations and other countries like some manufacturing sectors did. So I think by and large, that's tamed and certainly, again, part of our mix as we predict and estimate for the rest of the year. We think it'll be a good, very solid year for Nucor.
You mentioned legislation, and I think that is very important to the steel industry. As you take a step back, you had the Trump administration put tariffs on China steel. That seemingly good for U.S. steelmakers. But then, as you just mentioned, we had all this stimulus from the Biden administration from various different avenues. Which administration has been better for your business?
You know, again, Nucor has been well positioned. We've been advocates for fair trade, not free trade, for a very, very long time in our company. And again, you've seen 5-6 years ago, the industry only had about 50 or 60 cases that we had won against bad actors that were illegally dumping or subsidizing their steels. Today, that's more like 120. So we have great protections, and both sides of the aisle have been very supportive of the industry, including President Biden, Secretary Raimondo, Catherine Tyre, USTR. So there's strength there. And again, I don't think it can be overstated. You know, just the CHIPS and Science Act alone, to date, there are 34 semiconductor facilities planned to be built in the United States for a total cost of around $374 billion. That is a massive influx of steel demand, steel-intensive buildings that at Nucor is, again, continued as one of the safest, cleanest, most productive steelmakers on the planet to serve and continue to serve our customer base.
Is it fair to say then, you know, because of those tariffs, that China is no longer dumping steel in the U.S.?
That's correct to say directly. But again, the sort of whack-a-mole game continues to be played. And so those steels are moved to other nations, potentially manufactured or fabricated and having some downstream process that would remove them from the trade barrier or case that they were originally cited. So Do those steels move to Vietnam or other nations? Do they move to Mexico or Canada and then into the United States? So our advocacy, our vigilance in making sure the administration is aware of the policies and the things affecting our nation in a world of oversupply will remain part of our focus for decades and decades to come.
In terms of the stimulus plans infiltrating the U.S. economy, what inning do you think we're in? And how do you think they shape your earnings in 2024?
Yeah, we're really at the front end of that, but it's happening. We're seeing on the order books now, those orders are generating actual production in our plants today. But again, we're on the front end of that. But the stimulus you talked about, they're 10-year investment cycles. So we're going to continue to see that move up. And again, very construction intensive. So as you think about the products that we make and the rebar, plate, sheet grades, steel beams, joist, deck, metal, insulated metal panels, all of those things are uniquely brought together by our solutions group, and will continue to help serve those end markets incredibly well, and ultimately reward our shareholders with continued improved profits.
And that was Nucor CEO Leon Topalian.
Twitter has ditched the famous blue bird for a black and white X, part of a sweeping rebrand under owner Elon Musk that promises a wide-ranging everything app. But some analysts are skeptical the pivot will do more good than harm. A director at Forrester Research told the Washington Post Musk has wiped out over 15 years of brand equity in the Twitter name. Yesterday, crews began but never finished removing the old Twitter name and logo from its corporate headquarters. They didn't finish because Twitter reportedly didn't get the proper permitting in order to do so.
Shocker.
Also worth noting, the name X is already used by some rivals in the social space. Google's own startup lab is called X. Meta already has a trademark for a stylized version of the letter as well. So, I mean, it doesn't change the experience yet of being on Twitter. But I think but the experience of being on Twitter has changed since Elon Musk took over the company.
You're right, and two things I would be on the lookout for. One, what does this mean for Tesla? Is it now is it time to again worry about that he's spending too much time on this, potentially trying to relaunch this brand, whatever that might be? Those fears receded over the past months, and I would argue help fuel that bull rally in Tesla. That's one. Number two, what is all this confusion, this new layer of confusion regarding X, Twitter, whatever you want to call it? What does it mean for Snap? What does it mean for Threads? What does it mean for Meta? What does it mean for Instagram? Does it mean they are picking up business because advertisers don't want to be on a platform that is now clearly continues to be in major upheaval mode, and you can't necessarily get a line of sight to what this business is by year end? What is X? It's unclear. Elon might know, I'm sure he does. Linda Yaccarino, CEO of Twitter, I'm sure she knows what X is, but do advertisers know, and can they support this platform?
Well, they might not know yet. It's interesting, Axios out with a story today talking about Walter Isaacson's book that's coming out on Elon Musk, and according to their reporting, Isaacson saying that he's been planning this X rebranding for a long, long time before he even bought the company. But if he can't sort of articulate and show what it is, then it doesn't really matter.
His vision was always that, and it might be, I'm just speculating here, to turn this into some form of super app. But super apps, especially overseas, they have proven not to work. And then secondarily, do we need another payments platform? I'm okay with my Amex, man. Yeah. I don't know if I want to be paying my bills over on X or Twitter. I don't feel that safe.
Well, but part of it is that they would pay people for content in a different way. Seems to be the initial thing. I don't know. We'll see, is the bottom line.
Will we?
At some point, maybe?
Maybe.
All right, stick with us. We'll be right back. Will the S&P 500 be higher or lower at the end of earnings season?
Oof, I wish I knew the answer to that definitively. I guess I would say right now the momentum is obviously moving in the higher direction. Earnings expectations, negative 7% growth year over year, so the bar is still pretty low, easy to get over it. I guess if I have to choose one, I'd say higher.
China is pledging support for the world's second biggest economy and giving a big tailwind to basic resources in particular. Yahoo Finance's Jared Blickery joining us to take a closer look. Hi, Jared.
Hi there. It is no secret that the Chinese economy is off to a much slower reopening than hoped. The Chinese Communist Party's Politburo met on Monday, that's last night, to discuss how to aid the property sector, the principal wealth generator for the Chinese people, and also lower the burden of local government debt. As a result, the Chinese are now pledging support for commodities like steel, copper, aluminum, and zinc. But critically, authorities are stopping short of any bazooka stimulus on the fiscal or monetary side. And here we can see a number of minerals here. We got nickel. We also have zinc up about 3.5%. Copper, let's take a look at a year-to-date chart of copper. You can see the reopening in China was a little bit front run here. Dr. Copper selling off since then as hopes were a little bit diminished. Now, we got to take a look at the yuan as well, because yuan strengthened overnight by over 0.8%, the biggest move since March. Now, given the structure of the currency pair, a higher number means a stronger dollar, while a lower number means a stronger yuan. And let's take a look at the intraday price action here. This is overnight down 0.7%. Over the last 4 days, 1.3%. That's actually quite a bit for foreign currency. Now, the currency weakened past 7.3 to the dollar last October. This was the highest or weakest level since 2007. Now, in August 2015, Chinese authorities devalued the yuan by 3% in 2 days, spending over $320 billion of its foreign reserves defending the action, which was accompanied by capital controls and other measures that were a bit draconian. The Chinese want to stimulate demand without a big shock, but that is proving ever more elusive, given the diminishing returns of various stimuli. It's a quandary for the Chinese, but one that is having an immediate effect on U.S. markets, as demonstrated by the share prices of steel manufacturers today. And we can take a look at that on the Wi-Fi Interactive here. And you can see a number of these issues, including Nucor, up 4%, guys.
Jared Blickery, real great analysis. Appreciate it. All right, on Thursday, just 1 day after the FOMC's latest interest rate decision, the Federal Reserve will unveil a proposal for new bank capital requirements. The proposed rule would also lower the threshold for qualifying banks, meaning smaller institutions will face a new host of demands previously avoided. Fed Vice Chair for Supervision Michael Barr outlined a sweeping plan to overhaul bank oversight requirements earlier this month. The proposal, set to come out Thursday, will offer more specifics on just how significant those changes could be. Joining us now with the latest is Kyle Campbell, staff writer at American Banker. Kyle, good to see you here. I talked to Brian Moynihan, CEO of Bank of America, about this. He really took I would say a hardline view of this. This could really be impactful to the economy. What have you been hearing from sources?
Yeah, I mean, that's the big concern, right? Banks have been looking forward to these, this proposal for a long time now. Since 2017 is when the Basel III, they call it Endgame, was first finalized sort of internationally, and now we're implementing that. Where this is, what we're going to see on Thursday is just how that's going to impact the economy, because we're going to find out which particular activities are going to be given which sort of risk weights under the new framework. So if, let's say, auto lending comes with a much heavier capital penalty than a lot of banks are sort of, forecasting with their internal models currently, it's going to make that type of financing more expensive, essentially. And there is a view that as capital overall increases, it's just going to have a broader sort of tightening impact on the availability of credit broadly in the economy.
Is it really, or is it just that their margins are going to get smaller, or both?
I think it's probably a bit of both, but that's a great question. And certainly consumer advocates are saying, well, look, the way that capital is raised is, it's just hurting the bottom line for executives. You just have to retain earnings, and you lose that sort of ROE, return on equity, that is, what sort of fuels bank profits. So it's certainly going to result in less profitability, at least for some period of time. And, again, how that actually impacts the availability of credit to, the average person is going to really, I don't think it's particularly useful to try to forecast the overall picture, but you can get a good sense of how individual banks are going to be impacted by this once we see the specifics on Thursday.
For those banks, let's say a Wells Fargo, that have been struggling for some time, what does this mean for the struggling banks like a Wells Fargo?
Wells Fargo, it'll be interesting. I mean, obviously, they've started started to sort of move away from like mortgages, which is one area where there's going to be a lot of focus. What happens to mortgages? How does it get treated under the capital rules? I think that where it's going to be more impactful than on Wells Fargo. Certainly they're going to be hit to some degree, but I think it's really going to be most impactful on the sort of mid-sized banks, if you will, the ones that were in that sort of 100 billion to 250 billion asset range that are now going to be facing these risk capital requirements for the first time. I think the large banks sort of know how to deal with this sort of these sort of requirements, and I don't think that like a Wells Fargo is going to be as impacted on a sort of relative basis as like some of the smaller banks.
Let's turn to another issue that the market's been paying a lot of attention to, and that's commercial real estate and the risks associated with commercial real estate. In these earnings reports that we've gotten from banks, several of them announced steps to anticipate losses, to put aside money for losses, potential losses in commercial real estate. Wells Fargo, for example, boosted its allowance for credit losses. So where are we in that sort of situation?
Yeah, that's a great question. And certainly regulators are very focused on commercial real estate, giving some strong, warnings to banks to do things like, set aside losses and sort of avoid getting new exposures where you can avoid it. And that actually kind of compounds the issue because a lot of these, certainly with offices, we know the ones that are sort of, vacant, not getting people in, and that's sort of a whole issue unto itself. But there are some assets where they're kind of performing relatively well, but they're going to need some kind of a recapitalization in order to remain viable and not end up as a foreclosure. And in order to do that, you need banks to sort of come to the table. So I think what we're going to be looking for is who's going to move first. Are we going to see, some of these, sort of big capital equity investors, private equity funds start to come in and say, hey, we're going to move in a higher equity basis, or are we going to see some banks say, hey, actually, we're going to be willing to, back some of these recap type strategies through lending?
Is this a potentially destabilizing event for the banking sector?
I wouldn't think so.
I'm trying to compare it to what happened earlier this year.
Right, yeah. I think you're going to see some serious stress, and I wouldn't be surprised if at specific banks, you see some, possible failures that's, you don't want to throw that term around too lightly, but yeah, it's possible that some banks could, either have to be, sold, or go through some sort of an M&A activity to sort of right the ship here. I wouldn't expect it to get to a level where we're needing to see, serious intervention by the government because they're sort of very well aware of what's going on in real time. But these things can kind of snowball pretty quickly. So it could be something to watch for sure.
Yeah, most definitely. Kyle, thanks for coming in. Good to see you. Kyle Campbell, staff writer at American Banker, covering some various areas of risks for us. So let's do a quick check of the markets here to see where we stand. We got all three major averages in the green here, holding pretty steady throughout the session.
Yeah, it's the GM and GE stock rally today here, Julie. Wow, GE orders almost up 60%. If you would have asked me yesterday, will I ever see orders up 60% in GE? I thought you'd be living on another planet.
Well, yeah, because they kept as we talked about with Brian Landenberg. Landenberg? Anyway,
it's good. It's good.
That's the part of the business that is far and away doing the best right now is the aerospace part of the business.
Yeah, right, and I would say so far, one of the early themes of earnings season, we've been talking about it all morning long, inflation continues to cool. Nucor CEO calling it out to us, GM CFO calling it out to us, Whirlpool CFO, Jim Peters calling it out to us. Where inflation is not slowing is my bill yesterday, leaving the General Motors dealer for my car. That was a little bit of a tough swallow.
Did you buy another car?
No, I just had to get this one. I had to get a new part from GM. It was a couple $100, but I didn't expect that type of bill.
Well, right now companies appear to be in the sort of sweet spot, right, where there is some disinflation that's helping them in the cost side, but they are not lowering prices, certainly most companies, and so they still are preserving margins. The question is whether that is going to start to change at some point, and the margins are going to come in a little bit.
I guess I just helped GM make its third quarter earnings.
I guess you did. Indeed. All right, Jared Blickery's got you for the next hour of trading. Keep it right here.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery. Here's what I'm watching today. Spotify saw subscribers surge in the second quarter, but weaker margins and price hikes are the big focus for investors. How does this impact future results? We're going to discuss this hour. And home prices rose for the fifth straight month in May, but the regional gap is widening. We're going to discuss the latest housing data in a minute. Plus, the IMF is out with its updated World Economic Outlook. We're going to speak with the fund's chief economist on the persistent challenges. That's a quote that it's still seeing. But first, let's take a look at the markets. And we have, for the third day in a row, we do have a number of, all three markets are in the green. We see the Dow up a whopping 8 points. That could change at any time, but take it for now. S&P 500 up about 0.1%, and the Nasdaq leading the way up about 1/3%. And let's take a quick check of the Treasury market as well, where you can see yields bumping here, jumping. We got the 5-year up 5 basis points to 4.18%, the 10-year to 3.89%. It's also up 4 basis points, and the 30-year up just 1. Now, Q2 earnings season, it is in full swing. Investors are going to be keeping their eyes on big tech with results on tap from Microsoft, Alphabet reporting after the bell today. And while most companies are beating the street's expectations, JP Morgan strategists noticed that they are not seeing big stock upsides on these Q2 reports. Yahoo Finance's Ines Ferre is here to weigh in. Ines, the data, please.
Yeah, that's right, Jared. So it's an interesting note from JP Morgan analysts. They're saying that overall robust activity in the second quarter, that's going to lead to beats. However, what they're saying is don't be surprised if you're not seeing a big upside in stock prices like we perhaps saw in the first quarter and previous quarters. Basically, what they're saying is that these positive results are not going to translate into stock prices going higher. Keep in mind that the market was up in the season. Keep in mind the run up in the market in the first quarter, in the second quarter. And these analysts are saying that there has been a low hurdle for earnings. And we have heard that before, that the bar was set low when it comes to these earnings. So this thesis especially stands, according to these analysts, if you take a look at the guidance. So whatever guidance these companies are given will also determine whether you're going to see a stock price sort of more muted or if you are going to see the stock price going higher. So these analysts are saying expect to see a more muted reaction, even though you are going to be looking at predominantly beats. Now, these analysts looked at 70 S&P 500 results in the U.S. They also took a look at 90 in Europe. It showed that the majority are beating the consensus projections. And also, even though the sample set is small, the stock price reaction is what they're calling, in quotes, worse than typical, Jared.
Yeah, Ines, we got time for another one here. Just wondering, any tickers stand out? You've been following the earnings season. As you said, we don't really have the results from most of the constituents just yet, but anything standing out to you, tickers or themes?
Well, what I thought was interesting was just when the banks started reporting, and you saw that several banks beat on the top and the bottom line on revenue and profit. You had JP Morgan, Citi, Wells. Their stock prices, though, those were muted when you took a look at the reaction of the stock price. Even if you take a look also at a big ticker like Tesla, it has had a huge run up. Tesla beat on earnings by 91 cents, but the stock tanked, and that was mostly because of margin concerns and issues going forward. So certainly you are seeing it with some stocks. Look, the market has really had a huge run up. And part of the thesis here is that a lot of the positive activity is already baked in.
Yeah, a lot of it probably is. Thank you for that report, Yahoo Finance's Ines Ferre. It's been a very busy week for central bank decisions, and a lot of them still to come. The Federal Reserve's two-day policy meeting kicks off today, and its monetary policy decision is expected at 2 p.m. Eastern on Wednesday. We're going to be there. You can catch it live. Now, Fed funds futures are pricing in a nearly 100% chance of the Fed raising rates once again by 25 basis points on Wednesday. A 25 bip rate hike would mark the central bank's 11th rate hike in nearly a year and a half and take its benchmark interest rate, the Fed's fund rate, to a range of 5.25 to 5.5%, a 22-year high. For more on central banks, we're joined by Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, always great to see you here. What should we be expecting? Any tap dancing tomorrow at 2:30 p.m.?
Well, it's going to be interesting because, they've telegraphed pretty clearly a 25 basis point rate hike from the Fed. And then the question is, what's forward guidance? What do they tell us about the future? And that's a little less clear. I think that the Fed Chair Powell may try to indicate perhaps we're in for another pause, but he doesn't want to give up the optionality of raising rates further because inflation's not at target yet. The other wrinkle that's kind of interesting is that we may get a dissenting vote. We know from a handful of Fed officials have expressed the view, including Atlanta Fed President Bostic, that policy is already restrictive enough. So that might be the first dissenting vote we've seen in a very long time at this Fed. But I think the majority still wants to push on, wants to send a strong anti-inflation or inflation-fighting signal. I think that's what we'll hear from Fed Chair Powell. That optionality is very important to the Fed.
Well, Kathy, I want to hone in on that potentiality, the dissent that you marked as something that we could see. The Federal Reserve largely operates in consensus, and we've had Powell been able to stir up a big consensus over how fast and far rates should go so far. What does this mean, or am I just reading too much into this one particular thing that hasn't even happened yet, to be fair?
Yeah, I think it would mark probably the beginning of the end or, close to the end. We think the rate cycle is near a peak. This may be it for the Fed in this cycle. Because when you start hearing from various officials out loud that they think enough has been done, that's a pretty significant indicator because they usually try to stick to the same script. Again, I do think they'll go ahead. I think they'll still leave the option open, but I do think that might signal, if it happens, that we're pretty close to the end, that there's a group of people at the Fed who are not aligned with this, sort of never-ending rate hike cycle.
And in the background, last question on the Fed, I promise, but in the background, meanwhile, we've had quantitative tightening taking effect, the Fed's balance sheet being wound down. It's still north of about $8 trillion, so a very large sum. But do you have any feelings as to how further QT might affect the markets negatively? Is it affecting currencies, the bond market, just anything you might see there?
Yeah, QT is gradually reducing liquidity in the financial system. It's designed, quantitative easing is designed to expand reserves in the system. Quantitative tightening sort of takes it out. There's supposed to be a component of taking duration out or putting duration back in the market. That's really not a big factor. And I would say QT running in the background so far hasn't been a huge issue for the economy or for the market. But I do think we're looking at the pace they're going over the next year or two, $1.5–2 trillion lower on the balance sheet. That has to have some impact, probably diminishing impact as we go along, but still the equivalent of a rate hike or two in terms of its impact on the economy.
And looking ahead past the Fed decision this week to the next big economic reports, that would be on the inflation front, CPI, also PCE, and then we got a big jobs number in a week or two. What do you expect for these, and are we going to finally see a turn in the jobs market toward higher unemployment? In other words, a turn for the worse. You talk about the SOM rule or anything you want, something that might trigger a recession, but so far we've seen incredible resilience in the labor market.
Yeah, we have, and I think that's been one of the big surprises. Now we're starting to get labor force participation pick up, so that is improving the supply of labor, and so we're not getting quite as much upside in terms of the unemployment report, and we're still getting growth in employment that's really pretty solid, pretty healthy. It slowed down, but it's pretty healthy. But I think the key measure in the employment report is the wage growth data. So that tells you how strong the imbalance is between supply and demand. And wage growth has started to edge down, but it's still north of 4%. I think the Fed would be much more comfortable if it's in the 3% area. And that's probably kind of a back of the envelope goal that the Fed has. If you get wage growth back to 3%, the economy growing roughly 2%, you've got a pretty good equilibrium in the economy. Now, whether they can do that and achieve that soft landing, is anybody's guess at this stage of the game, but so far, so good.
All right, we hope so far so good continues. Kathy Jones, always great to see you, Chief Fixed Income Strategist over at Charles Schwab. First up on today's trending ticker is General Motors, which was tracking its second worst day of the year. It was down 5.5% as labor strike concerns weighed on the stock. However, price has recovered a bit. Losses have been pared to about 2% and change. You can see on your screen right there, actually now down about 4% intraday. GM did raise its profit forecast for the full year, but critically, the estimate assumes no labor strike. So there's a September 14th deadline looming with the United Auto Workers Union, and Oanda market analyst Ed Moya, friend of the show, is casting shade on said guidance because of expected hiccups in labor talks as the deadline approaches. Vital Knowledge is focused on GM's guidance raise, which was the second straight, adding that management is seeing healthy demand and stable incentives. And in the same vein of makers of things reporting earnings, Raytheon Technologies is down over 13% now, almost 14%, which is the most since the dog days of the pandemic way back in 2020. Investors are focusing on the defense manufacturer cutting free cash flow guidance for the full year. Much of the company's book of business is government contracts, and defense stocks in general have been performing well recently. But the underlying technology that Raytheon is developing is so cutting edge, apparently, that it's coming with unintended consequences. Jefferies notes that an issue with metal powder used in making certain engines, Raytheon boosted their profit forecast by a nickel, now expecting $4.95 to $5.05 for the full year. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
At the end of this earnings season, will stocks be higher or lower?
Well, the short answer is I don't know. I don't think anybody does. But I think that if you don't get the similar pattern that you saw in Q1, where the bar was lowered so much, then it was just easy to step over for pretty much every company, then you had this pretty miraculous rebound into flat territory, which is impressive when you go from down 5% to no growth, that climb upwards. And I think actually that had that was a big part of why the rally kind of persisted throughout the second quarter. So if you don't get that and you actually get cuts to guidance, which we've already started to see for the rest of the year, my guess would be you probably have some more stumbling amongst the bigger companies and the more high-profile names.
Let's do a quick check of the market sponsored by Tasty Trade. You can see everything in the green there, but the Dow just barely up 9 points. S&P 500 up 15 basis points and the Nasdaq up about 0.5%. The IMF is out with its updated World Economic Outlook, and it makes for challenging reading. Global growth is projected to fall from an estimated 3.5% in 2022 to 3% in both 2023 and 2024. The fund says forces are shaping the outlook. Notably, it says that events which hindered growth in 2022 are persisting. Touching on inflation, the IMF says it remains high and continues to erode household purchasing power. So where do we go from here? Yahoo Finance's Jennifer Schonberger is with a man that might have some answers, a very special guest. Jennifer.
Thanks, Jared. I want to welcome into the program the IMF's chief economist, Pierre-Olivier Garinchas. Pierre, it's great to see you. Thanks so much for joining me.
Hi, Jennifer. Very good to be there.
You have upgraded your outlook for global growth by 0.2 percentage point. What accounts for this resiliency, and how much of the potential dislocations that we could have seen from the regional bank failures earlier this year that did not materialize factor into this new outlook?
Well, we had a bit of good news, if you want. I mean, we had a more resilient economy, especially in the first quarter of this year. We had strength, in particular, in services. Services demand has been fairly robust, and that has sustained activity in a number of countries. And then, as you pointed out, the spillovers from the March banking turmoil remain very, very contained, very limited, thanks to very forceful actions by United States and Swiss banking authorities and the Federal Reserve, the Swiss National Bank, etc. And that has also lifted some uncertainty on the global economy, and financial conditions have eased after that episode.
And now, while you have upgraded your outlook overall, you do see slower growth for advanced economies, and you've actually increased your outlook for core inflation, stripping out those volatile food and energy prices for advanced economies both this year and next. My question is, given that you now see perhaps more persistent inflation for these advanced economies, what's the risk that the central banks in those economies will need to raise rates higher than what is perceived right now? And what risk does that present to the outlook for growth as well as volatility in the financial sector?
Well, so this is why in our update, our World Economic Outlook update, we're saying that, we're on the right track, but we're not out of the woods yet, because precisely we have some upgrade in growth, but the momentum is weakening going into the second half of this year and into next year. And also, quite importantly, we're seeing this underlying inflation remaining quite persistent. Now, of course, everyone sees that, the price of energy and food prices have been coming down. And so as a result, headline inflation has been coming down quite strongly over the last six months or so. But the underlying inflation, and some of it is related to the price of services, which have remained increasing at a fairly high rate on the back of this strong demand, that remains going forward at an elevated level. And so we are seeing, core inflation, as we call it, this underlying inflation, is remaining in the range of around, for advanced economies, 5% this year, and is expected to be still 3.1% next year, so quite far from the central bank targets. And so what that tells us is that central banks were probably near the peak of the hiking cycle in many places, especially among advanced economies. But the fact that you're near the peak doesn't mean that you're about to ease. And what we're likely to see is maybe a few more hikes. That may well be the case. But more importantly, rates are likely to remain elevated for some time until we get more significant disinflation on this underlying price of services and core inflation.
And building on that, the Federal Reserve is expected to raise rates for the 11th time on Wednesday in what could be the first of 2 more rate hikes this year. The IMF has called for at least 1 more rate hike here in the U.S. this summer. What do you think the outlook is given where inflation is in the U.S. right now? Do you think that 1 more rate hike makes sense and then holding at that level, or do you think another rate hike is warranted?
Well, we have in our assumptions for this round of projections, we have a terminal rate for the Federal Reserve that is around 5.6%. and that would be reached in this year, and then the Federal Reserve would remain at that level for some time. So we have also, in line with what the Federal Reserve has been telegraphing to the markets and to the world, we are also seeing some likely rate hikes in coming. Of course, they're making a decision this week, but also maybe at subsequent meetings. But again, these are sort of modest hikes compared to the very, very large hikes we've seen in the last year. We've had about 500 basis points in increase in interest rates. We're unlikely to see that again because, well, we see the inflation pressures moderating, and that's the good sign. But what we are seeing is also there might be a delay before central banks, including the Federal Reserve, are in the position to start easing rates. And that may not happen until well into 2024.
But Pierre, do you think one rate hike is enough to hold at this level, or do you think the Fed needs to do 2 more rate hikes here?
Well, we don't have necessarily all the information that the Federal Reserve has in making its decision. What we're thinking is 1 or 2 regular rate hikes of 25 basis points would be reasonable in the context of what we're seeing in terms of inflation pressures, and would be consistent with the path for both economic activity and inflation coming down towards the end of 24 and into 25 back to central bank targets.
The U.S. is set to formally propose Basel III capital requirements on Thursday. Does the IMF believe a customized or tailored approach is needed depending on a bank's size or the risk that is being taken on? And what impact do you see these higher capital requirements having on lending as well as growth?
Well, first, we should say that, we are in favor of, a common implementation of international standards across all countries. I mean, this is very important to avoid any form of regulatory arbitrage or any fragmentation of global markets. Having said that, included in Basel III, there is some element of proportionality depending on the size of the financial institutions or the banks. And again, so we are supporting an implementation that is in line with the Basel Committee recommendations. In the case of the U.S., it probably means that the prudential requirements for mid-sized banks need to be aligned maybe a little bit more with what we see for larger banks. And we've seen that some of the fragilities, some of the vulnerabilities in the banking sector were precisely in these mid-sized regional banks. And it's important to avoid having an episode like that in the future.
All right, Pierre, we'll have to leave the conversation there. We are out of time, but I so appreciate your insight. Look forward to speaking with you again soon.
Thank you, Jennifer.
And that's Pierre-Olivier Garinchas, Chief Economist of the IMF. Jared?
And thank you, Jennifer, for that report. U.S. home prices grew again in May from the previous month. For more on the latest details, let's bring Yahoo Finance's Danny Romero away. What are the key takeaways here?
Buyers are taking advantage of the slight dip in mortgage rates and are competing for a home, Jared. Home prices grew over the last month, and if we take a look at the S&P CoreLogic Case-Shiller National Home Price Index, it grew about 0.7% in May. This is the 4th consecutive monthly increase. And if we also take a look at the index measuring the 20 largest cities across the country, that grew about 1% on a seasonally adjusted basis. What does this mean? Buyers are taking the hit and buying a pricier home as there is limited housing inventory out there. Competition is heating up for buyers, specifically causing certain areas to become reheated again. For example, Chicago, Cleveland, New York reported the highest price gains, increasing about 3% to over 4% in home prices. So if you think that's odd, so do home experts. And one region that is still lagging is on the Pacific Coast. For example, Seattle and San Francisco, they had the largest and worst price drops ranging around 11%. And the Midwest was the best performer, rising about 2%, Jared.
Danny, we've been talking a lot about the Fed. Their meeting kicked off today. Big decision tomorrow at 2 p.m. What possible repercussions could this have, another rate hike have on the mortgage market? Because we know rates are high already, but the Fed raises short-term rates. They don't really act directly on the longer-term rates.
Buyers' appetite hasn't been killed yet. Buyers are adjusting to higher mortgage rates, higher home prices. We're seeing that in the data, right? And so housing experts expect that home prices will fall pretty soon, depending in the coming months, they say, as unemployment is likely to rise, Jared. And that could impact the housing demand. But again, that is a wait and see type of factor. the story here is still the tug of war between supply and demand.
And it seems like demand is on the faltering side and secular tailwinds here. Looks like we don't have enough houses for quite a long time. Thank you for that, Danny Romero. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
What sector of the market do we not pay enough attention to?
Consumer cyclicals. I think we want to know where the economy is going. That's one of the best ways to find out where people are spending their money on discretionary purchases, so I guess consumer discretionary as well. Let's see where those are going, and that'll tell you a lot about how the consumer, which is 2/3 of the economy, is going.
Spotify came out with its second quarter earnings result this morning. The company missed on expectations and gross margins, even as the music streaming giant saw a jump in premium subscriber users and monthly active users. Let's bring in now Mark Mulligan, the Media Research Managing Director, to dig into these results and see what they mean for the company and the streaming music space. Great to see you here again. And could you just give me your first blush after looking at these at this release?
Sure, yeah, thanks for having me on. So I think the first thing is you have seen really consistent, strong user growth from Spotify over the last sort of outperforming the market for the last year. It's increased its market share. It's, for such a mature market to carry on finding pockets of growth. So from a user perspective, Q2 saw a continuation of that incredibly strong growth, over 500 million users in total. Roundabouts like 27% or so year-on-year growth in terms of total users, about 16-17% year-on-year growth in subscribers. So all that stuff is great. What is less positive is the fact that ARPU has been declining. Why is ARPU been declining? Because fundamentally, so much of that growth in this relatively mature market in Western countries is really being driven by emerging markets. So we're talking about Asia Pacific, we're talking about Middle East and North Africa, Latin America. These markets are driving users, but they're spending less. That's pushing ARPU down, which is meaning that revenue is becoming a bit decoupled in terms of growth from users.
So let me get this straight. If most of the incremental revenue, at least the changes, the growth is coming from international, what does that say about the domestic market here in the U.S.? The CEO has had his eye on a lot more than just streaming music. You can go back to interviews before the pandemic even. Is he missing the mark? Is this just a pivot to a different strategy?
So first of all, when we look at the US market, the US music streaming market is incredibly mature. It's by far the biggest in the globe, absolutely towers above any other major streaming market globally. But the growth there is coming to a close. You know, the strong period of growth. So Spotify is really, not doing anything different from the rest of the market there, which of course makes all of these new revenue streams like podcasts and audiobooks so much more important. And clearly podcasts has been growing really well in terms of users, really well in terms of catalog, really well in terms of user engagement, but the revenue generation has been slower. So I think we want to contextualize this in a bigger story, is the next couple of years for Spotify is essentially going to be telling the markets, back us for another growth story. You've had the growth story in music, now back us for a longer term growth story about podcasts, audiobooks, and all the other things which they want to build around in terms of the broader proposition of what Spotify can be.
So am I reading this right, that they're counting on the ecosystem to add value to the podcast segment, and that they can therefore monetize it a little bit better? Is that where they're going? Because they spent, by my count, over $1 billion on people like Joe Rogan, the Obamas, Prince Harry, the Kardashians, et cetera.
Yeah, I think I would look at sort of Joe Rogan as really sort of Spotify's House of Cards moment. It was overspending to get something really big to say, we're here, we've arrived. And I think they're moving on from that now. They've made a commitment to not wanting to overspend for podcast content anymore, and really looking at how they can drive a much more diversified and essentially more organic podcast market. Spotify is the #1 platform globally in terms of audience share. So it's got itself really well established, and it still has only converted a minority of its total music base to podcasts. So I think there's a huge amount of ecosystem play to be had there. But ultimately, the thing that will drive the revenue success of podcasts for Spotify is the wider market shift. We basically need more of those big advertisers who are still spending big on radio to start making their move into podcasts, to start shifting their budgets there. That is when we'll start to see the revenue shift.
All right, so that sounds like a structural shift, not something that's dependent on the cyclicals in the economy. How do they get there, or are they already on their way and it's just a matter of continuing to execute?
Yeah, they're certainly on the way. And as you can tell by my lack of hair, I've been in this role as an analyst for many, many years now. And I remember very similar shifts happening when we first saw the shift to online advertising, to mobile advertising, to social advertising. Essentially what happens there is a long lag period where the big advertisers sort of only dabble, experiment with smaller parts of their budget. And then finally, there's a tipping point at which everybody starts jumping in like lemmings following the first one over the cliff. That moment will come sometime in the next couple of years. Spotify's positioned itself to be at the front of the queue. So I think, yes, there is a bit of cyclicality in it, that the ad market is a bit softer at the moment than it has been. But fundamentally, they're waiting for the secular shift and to ride the wave.
We got time for another one. So could you please talk to me about the company culture? I remember when they pursued their direct listing, they specifically did not want to go the traditional IPO route. They didn't really need the money, so they didn't take it. And they came to market in a way through a direct listing that avoided a lot of the IPO foibles, I guess, that pop up from time to time. Also a European country. What is the company's ethos, and how does that guide their decision and the things that we're seeing play out with the company today?
I think there's, you can take this as a strength or a weakness depending on your perspective. But I think one of the things that Spotify has managed to be able to keep at its core culturally is very much a sort of startup mentality, even though it is far beyond being a startup now. So it has a huge amount of innovation. It is very ideas driven. It is always, it follows a sort of a bets mentality according to the things it's trying to pursue. It's always trying to innovate and, try out new things, immersing itself in evidence, really pushing, trying to push the envelope. And many of those things don't see the light of day. It's always almost like this, perpetual skunk works at play. Yeah. So that culture of innovation, I think, will serve it well as it, sort of essentially tries to move into a whole set of new markets.
Got to leave it there. Really appreciate your insights. Media Research Managing Director Mark Mulligan. All your markets action lies ahead. Stay tuned. You're watching Yahoo Finance.
How would you describe the consumer right now?
I would say the consumer is bending but not yet breaking. When you think about the bend, certainly excess savings have been spent down pretty much when you look across all income quintiles. When you look at 401k hardship withdrawals, we're getting anecdotal evidence that some folks are tapping on those to potentially fuel some of their spending. But they're not necessarily breaking, right? They're still spending. If you were to look at, we talk about revolving credit debt in aggregate, and I know the number is a scary number, but if you look at it as a percentage of disposable income, it's actually below where we were prior to the financial crisis, and it's creeped up a little bit, but roughly where we were at just right before the pandemic. So I think we're seeing a normalization in credit usage, not necessarily consumers coming overextended. So I would say consumers are bending, but not yet breaking at the moment.
Investors have been keeping an eye on the different areas of the AI boom. Artificial intelligence's ability to assist with search functions and how it might impact advertising spending revenue is just one of them, particularly in the case of Google, which dominates the world with its search engine. And according to GS StatCounter in 2022, Google made up 91.9% of the search engine market. Inuvo focuses on being a market leader and using AI for advertising, and its chairman and CEO, Richard Howe, joins us now to discuss. Richard, thank you for joining us. I was reading about your company, really interesting how you go about your business. Basically in the ad market. The ad market electronic for online advertising structurally changing. How are you using AI to take advantage of it?
Yeah, the big problem in advertising is for 30 years it's been using identity as the fundamental basis for targeting, for creative, for figuring out which devices are attached to a person. There's just no aspect of advertising that hasn't been based on identity, and that's going away quickly. Most people would know that as the cookie challenge. And what that does is it actually offers an opportunity to sort of free yourself, if you're a marketer, from marketing that's been based on who someone is to based on why someone's interested in your product, service, or brand. And that's where AI comes in. The technology that exists within AI now allows us to not just solve the privacy problem, but really change the paradigm to a more powerful answer to the way you find audiences. Why are people interested in my product, service, or brand?
You have a really interesting example online I found on YouTube that has to do with the Carhartt jackets and the coats. And could you just kind of break down step by step how your company goes about using a product such as this and gaining insights through artificial intelligence without having to glean that information from the users themselves?
Yeah, you bet. The Carhartt example is a good one. There's a lot of them, but I'll hit that one since you've asked for that one. Fundamentally, this kind of AI is based on a language model. There's a lot of different categories of artificial intelligence. A calculator is AI, but this kind is based on the language, and it's based on the language because we humans, we experience the world through the language. So it's read the entire internet. It's been able to associate all the concepts that exist in our language one to the other, and all the pages that are on the internet one to another. And what that allows this AI to do is to associate things. So Carhartt, take a look at them. If as a company and as a brand, they really have sort of owned the worker space, like jackets and outdoor wear, specifically for people working hard in the fields. And one of the things that our AI is able to do is associate things that you normally wouldn't think are associated. In this case with Carhartt, it was the movie Interstellar. So because our AI's read everything about Carhartt, and because our AI's read everything about everything, it knows there's a relationship between that movie and Carhartt. Now it knows even more than that. It's not just the movie Interstellar. It knows that Matt McConaughey and Jessica Chastain are actually wearing Carhartt gear in that movie. And as a result, there's an audience there that you could target that you would never have been able to identify simply because the technology doesn't work that way.
So if you're able to read the entire internet, you're going to stumble across some things, maybe some connections that you don't want. There's going to be a lot of hidden biases in there. And how do you tune your AI software? And maybe it's not just a concept of tuning, maybe it's more structural. How do you build in safeguards into the AI software to make sure it's coming up with relevant and appropriate terms and linkages?
Yeah. So when we have our clients, some of the things obviously that they care about is they don't want their ads associated with, let's just say, content that may be not associated with what they're looking for. I mean, probably a good example of that is an airline, certainly doesn't want, any other marketing materials on sites talking about plane crashes. There's ways to filter that out, so that's one example, but there are many ways to do that. The good news about using this kind of a why-based approach and not having any relationship or the use of third-party data, consumer data in any way, is there, these sort of inherent biases in the way that we think about biases don't exist because, again, it's not about the people. It's about the reasons why groups of people are interested in something.
Have you done a direct comparison between the old method of using cookies and tracking user behavior across sites and your current method? Is it better or worse? I would imagine just blatantly scooping up everybody's data is going to give you much better results, but maybe I'm wrong.
Absolutely. So it has, the benefit of clearly solving the privacy challenge, which is the fundamental problem facing the ad industry right now. And the added benefit, because the technology is so much better than the technology we actually invented when we invented the current ways of improving. So you get a better product, and you get to solve all the challenges associated with using consumer identity. And consumers are basically not getting unhappier all the time with people using their data. And of course all the the manufacturers of like browsers like Apple are starting to prevent using those methods. So yeah, it's got double benefit.
Any numbers you can throw out here, or have you not done any back-to-back study like that?
Yeah, we track it all the time. So if you think about it this way, we in any implementation where we implement the AI, we go up against probably somebody using identity-based tech, and on average, we beat it by 50%.
Impressive. We got time for one more, just under a minute. Anything you'd like to add to the conversation?
I think it's important for marketers, to understand that a future, devoid of identity is upon us, and the sooner they start thinking about providers and technologies that can help them move away from that, actually, I think the sooner they'll be unshackled from the structured nature of that approach to marketing and open themselves up to new possibilities. It's like any change in any market. You got to make the leap, and then once you do, you're like, oh wow, am I ever glad I made the leap.
And change is coming ultra fast now, thanks to the technology. Really appreciate your insights. Thank you, Inuvo Chairman and CEO Richard Howe.
My pleasure.
Albertsons beat expectations this quarter, citing steady grocery demand and private label brands. Let's bring in now Yahoo Finance's Brooke DePalma to break it all down for us. Brooke.
Good morning, Jared. That's right. Albertsons beat on both the top and bottom line this past quarter that ended on June 17th. Adjusted earnings per share coming in at 93 cents versus expectations of 84 cents. Revenue coming in at $24 billion compared to expectations of $23.9 billion. Now, same-store sales also coming in higher at 4.9% this past quarter as consumers continue to look for value and cheaper options as inflation, food inflation that is, year over year continues to remain higher. Now, Albertsons also has heavily invested in its customers for life strategy. That includes digitally connecting and engaging consumers using tech in stores, similar to what we've seen at Walmart as well as Target, modernizing its supply chain and also investing in private label. Back in May, the company consolidated its private label business under one single label called Signature Select. And as you can see here, it's buckling down on loyalty. Digital sales increased 22% this past quarter, and loyalty members increased 16% to 35.9 million members as it looks to compete for consumers to turn to Albertsons for deals and for value in this inflationary environment. And so lots to look out for as Albertsons look to remain on top of grocery chain competitors.
Well, and to remain on top, there's also a little bit of a merger that has been pending now. Albertsons, Kroger, potential tie-up there. And Albertsons actually declined to provide guidance because of this. Anything to read in there?
Yeah, well, Jared, it's been 9 months since that announcement about that nearly $25 billion deal. And as you noted, it's still awaiting approval from regulatories. It's also gotten lots of pushback from local unions about potential job losses, which executives have said that it will not do. But in addition, it's also facing pushback about what it will do about potentially having to divest stores. And so lots of noise about that merger, but no deal, no announcement about that approval has come yet. But in addition to that, we did hear that it was set to still close in early 2024, but no exact date around that yet. But Vivek Sankaran, Albertsons CEO, providing some color about what exactly they expect for the rest of the year, saying that they are mindful of the evolving economic backdrop, including slowing food inflation, declining government assistance, and higher interest rates. and their potential effects on consumer spending and on the business. Now, as of the latest CPI report, month over month, grocery inflation continues to remain flat. Of course, we're getting a new CPI read in just a few weeks, but food inflation and the impact on consumers' wallets continues to remain a top story and is certainly weighing on Albertsons' bottom line.
And I'm still feeling it at the supermarket as well. Thank you for that, Brooke DePalma. All your markets action is ahead. Stay tuned. You're watching Yahoo Finance. Consumers are pulling back on home appliances. Whirlpool saw weaker demand for its products despite signs of inflation easing. Julie Hyman and Brian Sozzi spoke with James Peters last hour, and here's what he had to say.
What we're seeing in terms of demand, you could probably break down into three different buckets here. And if you think about our business, there's a big part of it that's replacement, and that's 50 to 55% of the appliances we sell. And that segment is relatively stable and strong and pretty predictable. The next part is what we'll call discretionary spend, and that's about 30% of our business or 30% of the industry. That's the segment right now that I would say the consumer is still relatively tentative in. And part of that is driven by existing home sales are still relatively low. And if you think about it, when people buy an existing home, one of the few things they do change out when they move in might be the appliances. So that segment right now we would say is below where we expected, but is relatively stable. Now, the last part of the industry in our business, which is about 15% for us, is new home construction. And we're beginning to see that pick up. And I think you've seen in the last couple of weeks, a couple of the large builders come out and be rather positive. And we're seeing the same thing. We're beginning to see their business pick up, which means in about 6 months, our business picks up as those homes are completed. So, as I said, it's probably a mixed bag on demand within the U.S. And then if you go outside the U.S., part of what impacted us within the quarter is that demand in EMEA was down by about 10%. And that's just the macroeconomic environment there and lower consumer sentiment. But as I said, in the U.S., we are positive on the demand in the future, and we do believe we'll begin to see some of that pick up. And with people who can't find existing homes, many of them will turn to remodels at some point, which then falls in that discretionary bucket for us.
Jim, it's Brian here. Good to see you as always. How fast will that rebound in the U.S. housing market take place? This week, we're supposed to get what could be the last interest rate hike for this cycle from the Federal Reserve. What does that mean to the next 6 to 12 months in the housing sector?
Yeah, no, that's a good question. Like I said, we're already seeing the signs of new home construction pick up as, people who are in the market for a home and couldn't find an existing home due to low inventory. And the reason there's low inventory, as many of us know, it's with mortgage rates where they are. Nobody wants to give up on their, 2.5%, 3% mortgage to take on a 7% mortgage right now. So we expect to see that pick up in new home construction, over the next 6 to 12 months. I think then as you look to next year, we would expect to begin to see, as interest rates stabilize and it's kind of been absorbed and normalized within the marketplace, you'll begin to see some of those existing home sales pick up. But right now, I'd say new home construction will be the first thing to show signs of growth.
And Jim, for the people who are buying new appliances, what kind of choices are they making? Because I know you guys have, you've been doing more sales, more promotions, but at the same time, you've been leaning into some of your higher end stuff. I know you guys bought InSinkErator. I am an InSinkErator owner myself with a kitchen reno that I did. So how many people are making those higher end decisions right now of your customers?
Yeah, I would say, the mix, and first off, thank you for buying InSinkErator, but the mix of our customers we see right now is relatively stable and pretty much in line with what we saw, historically and especially pre-COVID. Now, as I mentioned, as new home construction picks up, what you do start to get is a disproportionate amount of kitchen appliances because every new home takes on average around 5 appliances, the majority of those being kitchen appliances. So, that's the categories that we expect to see pick up. I'd say right now, though, our balance of sale or our mix of product is relatively similar to what had been in the past, as well as our mix of brands. We still are seeing the consumers buying in the premium space and also in the mass space. So despite the fact that the promotional environment has returned to levels that we would have seen before COVID, I'd say, consumers are still buying at that premium and especially that mass premium segment right now.
All right, that was James Peters, Whirlpool CFO, and we're going to take a quick check of the markets here. Everything in the green. The Dow was up by about 0.2%, S&P 500 up 0.3%, Nasdaq leading the way up 0.2%. Also taking a quick look at the bond market, the 10-year T-note yield has been on the rise. It's up 3 basis points to 3.89%, and also taking a look at the 30-year, that is up to 3.92%. That's it for now. I'm Jared Blickery.